It's really demand-driven inflation that we're dealing with, and that is something the Fed can, in fact, handle.
I think the market is pricing in this very specific outcome where we head into a very moderate or mild recession.
Our view is that it may be a soft landing for the labor market.
There's a lot of talk about U.S. recession risk, but the truth is the problems seem much more gloomy in Europe.
If we look at the rest of the world, there's just a world of trouble out there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Looking ahead to retail earnings in America, live from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down TK about 0.1%. Walmart and Home Depot coming right up.
Home Depot is incredibly important, John. I really give it a FedEx equivalent of a pulse of the nation. Joe Feldman over Telsey Advisory Group a couple days ago reaffirmed a stunning call of strength of Home Depot with margin expansion, John, and that's the kind of optimism that speaks to a resilient market. John, I'm going to say it here. The equity market performance yesterday was critical.
In the face of some weak data, we squeezed out a day of gains. This morning, Lisa, it's all about the numbers, and the numbers drop right now.
Yeah, Home Depot reporting second quarter net sales that beat expectations, $43.79 billion versus the estimate of $43.57 billion. Also, earnings per share beating on the headline figure of more than $5 per share versus an estimate about $4.50 per share. How much does this really climb to this fear to sort of push away the fear of a worst case scenario, especially in the housing industry that has been beaten up so much? How much does this give faith that you can get some sort of resurgence in consumer spending, especially with lower gasoline prices?
I have to say, for me, away from the numbers, Lisa, the big headline there is reaffirming the outlook, because we've seen retailer after retailer struggle to do just that. TK, that's what Home Depot does this morning. Reaffirms fiscal 2022 guidance.
They do, and the numbers are up. And the first thing I saw was comp sales 5.8% versus 4.6-ish, et cetera. And across the board, these are good numbers. It'll be interesting to see if the entire market reacts to this. I don't see it now with SPX and -7 futures.
Stocks down about 0.1% in the pre-market. Walmart, the big one, a little bit later this morning, Tom. We'll get that in about 60 minutes from now. Walmart, of course, in the last month coming out, and again, cutting the outlook. We've seen that how many times from Target over the last few months? That seems to be the theme for the retailers.
And particularly for our international audience, these are not equivalents. I can't say that enough. Basically, to help continental Europe, Home Depot is run like a Swiss watch, and Walmart's sort of run like Liverpool. Or
is that your take this morning?
That's my take this morning.
I think Lisa might have a deeper dive on the numbers, Tom.
Well,
Go on, Lisa.
I just think it's interesting that customer transactions were down by about 3%.
There we go.
How much are we seeing this across the board? Companies are able to raise prices. Companies are able to sell more on a volume basis, on a dollar basis, on a nominal basis because of inflation. So they do see that pop in earnings, but overall transactions are not climbing. This is classic stagflationary types of earnings where stocks could be the haven play, actually. Here's your bullish tilt to this. But on the bearish side, this doesn't really scream incredible growth.
Lisa, don't get too bullish too quickly. We're 2 minutes in. Home Depot behind us, Walmart in front of us.
You call that bullish?
Almost. On the edge of bullishness
I
for you
am
anyway.
so
Everything's
gonna
relative.
shut up here.
Everything's relative. In about 57 minutes, we'll get some numbers for you from Walmart. Lisa's going to break those down for you. I'll break down the market for you just briefly.
Please.
We're down about 0.2% on the S&P. On the Nasdaq 100, down about 0.2%. No real drama here this morning. A summer Tuesday, can we call it that? I think we can. Yields up about a basis point at a 10-year. Sub 280 at 279.87. Crude down yesterday. Down again today, 88.82 Bramo. We're down about 6 or 0.7%.
All right, on this quiet summer Tuesday, let's go through things pretty quickly. We do get those earnings from Walmart coming up after the Home Depot report that did beat expectations. Just to give you a sense of where we're coming from, Home Depot shares are down 24% so far year to date. Walmart shares down 8.4%. How much can they basically push back against the gloom and say we're doing just fine, we're reassessing, we're rejiggering our business model in light of some of the shifts that we're seeing demographically, and we're going to get it under control. Also at 8:30 a.m. we get July housing starts and building permits. This comes after that home builder sentiment index yesterday was just brutal, absolutely plunging, as a lot of home builders are looking at higher mortgage costs as well as generally plateauing valuations, if not declining. How much do you see that bleed into a slowing of how many houses begin to be built? And at 9:15 a.m., this is the read on the auto sector, July industrial production. How much do we get some sort of working through the supply chain kinks, especially after you saw the Empire Manufacturing Survey yesterday, John? Really shocking. Normally not that important, but this is one that tracks the ISM data pretty closely, and we saw a massive, massive collapse in terms of confidence for what to expect going forward. And John, how much does that bleed into the other industry sectors that have seen improvement, like auto manufacturing?
Lisa, it was shocking.
It was
shocking. I think
shocking.
our theme this morning is getting whipsawed from one data point to the next. Payrolls, everything's great. The Fed needs to do more. CPI soft, the Fed needs to do less. And then Empire yesterday, and everyone all of a sudden is confused and struggling with the idea of where we are in this economy, Lisa.
Exactly. And then you get Home Depot reporting better than expected earnings, and you get earnings in general that look better than people previously thought, where you don't see the same sort of margin compression that people have been expecting. How do you piece this together in some sort of cohesion?
That's the job of George Concalves. We'll talk to him now, the head of US macro strategy at MUFG. George, just help us out, buddy. What's going on in this economy? Payroll says one thing, Empire Manufacturing another, CPI one more. What's the story?
Good morning, John. Yeah, so I think we're still reeling from the unevenness of both the reopening, the supply chain disruptions. An economy still kind of moving beyond the pandemic, and you have that plus the stimulus, and you have just a lot of these cross currents which are sending mixed signals. But these high frequency indicators are clearly, and they have been for at least 2 quarters now, and they've been clearing that we're slowing down. You can dismiss the whole technical recession that happened in the first half and not utter those words. But on a go forward basis, I mean, we are seeing the parts of the economy that are very sensitive to interest rates reacting very quickly.
George, what do you make of the fact financial conditions continue to stay easy? The Bloomberg Financial Conditions Index, which is really good math, 11 ratios, confounds the gloom crew. What does that signal? How are we seeing that?
Yeah, that's a great point. And I think this is really just makes the job of the Fed much more difficult. Look, I mean, the markets have taken this pivot up to the high court of monetary policy, really thinking that, just like they priced in hikes, they're going to somehow, finesse the Fed into actually easing in the next, couple of quarters. And I think what we're finding now is that this could be a bear market rally. It's influencing credit spreads. It's influencing the equity market. Tremendous big moves. We've seen this historically. So we don't want to read too much into financial conditions, but if they do not ease from here, then the Fed's job is much more difficult. I mean, I think, as we get into September, the double tightening of the full QT in full effect, and the Fed most likely hiking at least 50, and I think the risk of 75 is still out there. So I think it's still early days. I think financial conditions have eased way too much, and the Fed's going to lean against it.
Right, the Fed's going to lean against that. Although on the flip side, and this is possibly what's causing a lot of the optimism, you see commodity prices rolling over yet again today in the face of weakness in China. And I go to Alan Ruskin over at Deutsche Bank. Traditionally, they have been coming out on the side of a hard landing. And he said right now, as commodity prices decline, the more optimistic soft landing scenario has been given at least a semblance of a chance, even if they continue to reaffirm their hard landing story for 2023. Do you agree? Do you think that this is a commodity story that is giving some breathing room to the Fed and to markets?
Look, I think the distribution of outcomes have improved for sure. So after last week's CPI and just the kind of move in commodities, to your point, is giving people some hope that somehow the Fed can finesse a soft landing. I mean, I think the probabilities have increased for a soft landing. I don't think it's still the base case. I think still that, maybe not a hard landing, but we're definitely going to see some sort of recession-like environment in the year ahead. But I mean, yes, of course, that's what markets kind of climb onto. I think it's too early to make that call.
George, it's the weakness abroad that gets our attention at the moment. In China, the data was terrible. Not just China, in Europe too. Europe wishes commodities were coming down. It's crude that's doing that. Gas isn't. Gas is going the other way. George, can Europe avoid a recession? Can China avoid a severe growth slowdown? And where does that leave this whole theory that the US can engineer a soft landing?
I think it's going to be challenging to have all those stars align in a way where, all of these major regional blocks can actually, muster a soft landing, let alone growth. I mean, the U.S. will probably fare better than all of them. And I think that's, the benefit of both. We still have this massive savings that's out there, but the consumer is suffering. I mean, if you look at, overall consumer trends and credit trends, there's a clear bifurcation happening on even here at home. So I think, you can have like a U.S. economy that has like 2 speeds, and it's really, you're hurting different parts of the economy.
George, awesome to catch up. George Concavas there of MUFG. I'll talk about gas prices a little bit later in Europe, but I can tell you, Tom, prices 12 times higher than the seasonal average of the past 5 years over in Europe. Looking at European benchmark prices, the team here at Bloomberg, Tom, breaking those numbers down. Just unreal stuff.
The demarcation's there, and it's going to be emphasized by strategists. I thought the J.P. Morgan note yesterday afternoon, John, was incredibly nuanced and important. Marko Kolvanovic really pointing out how Europe is discrete and separate as he talks enthusiastically about many other geographies.
We feel the uptick in risk appetite is justified, was the takeaway from Marko.
Well, there's a lot there. I think that the note, besides a tactical view, and it was very carefully written, John, is global, not U.S., global inflation coming down. And the key word here, John, is rapidly. If we get a Kolanovic, there it is. If we get a Kolanovic inflation dynamic, John, all bets are off for the Bears.
At some point, that clock's going to be right, Lisa, for the team over at JP Morgan.
Look, you could say the same thing about me in terms of my tilt on the world. At the same time, this is somebody who traditionally has been bullish no matter what. And so to basically take this view is a good way to get a read on sentiment in terms of what flavor the optimism has. And right now, the flavor has commodity disinflation written all over it.
Let me give you the flavour of the morning. It's a snoozy one so far. Futures down about 0.2 on the S&P. If you're just tuning in, the data out of Europe, investor confidence in Germany down. Real wage data plunging in the UK. Capital economics on Europe, on Germany. A recession is unavoidable in the second half. That's the takeaway at the moment. Tom, we need some clarification from you. This on Twitter. Can Tom Keene clarify whether Walmart being run like Liverpool was a dig or praise? It's 50-50 at this point in the season.
There. The late great Peter Bernstein would say there's a massive ambiguity there. I think after the sportsmanship that we saw from Liverpool yesterday, all bets are off.
Would you call it sportsmanship, Tom, that red card?
What do they do to that guy?
He's going to get suspended for a couple of games, I think.
A couple is all? You don't throw him out for half the season?
You think he should miss half a season?
I don't know. I'm not qualified.
For half a headbutt?
What do I know, John?
I don't know. Just wondering what your view is. You're comparing them to Walmart.
My view is they're not Nottingham Forest.
I'm pretty sure I still didn't get clarification whatsoever.
They're not Nottingham Forest. I'd keep it there.
Lisa, what was it? A dig or praise? We don't know.
It's 50-50.
Okay.
It could go either way.
Anastasia Amoroso is going to join us to talk about this market in about 50 minutes. You have a drink. Futures down just a little bit from New York City. It's a beautiful one. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Iran is signaling that it may be closer to a deal with the US that could restore Iranian oil exports to global markets. Tehran has sent the European Union its response to the bloc's proposal for reviving the 2050 nuclear accord. The government expects to hear back from negotiations within the next 2 days. Now, the next Prime Minister of Singapore is signaling that the wealthy may have to pay more taxes. Deputy Prime Minister Lawrence Wong has told Bloomberg the government probably needs to, quote, lean some more in the direction of inclusive growth. Wong also said Singapore can make sure spending is targeted at lower income. In the US, a Justice Department opposes the release of an affidavit justifying a search warrant for documents at Donald Trump's home in Florida. The search warrant itself has been released, but the Justice Department said the affidavit includes sensitive information about the investigation, including witnesses interviewed by the government. After a number of delays, Apple has set a September the 5th deadline for corporate employees to be in the office at least 3 days a week. Coronavirus surges delayed the company's plans several times. Apple has been making other COVID adjustments. It has also dropped its mask mandate in office common areas. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The Fed funds rate should be going well above 4%, 4.5% to 5% in my view, to really push inflation towards 2%. If that doesn't happen, inflation expectations are going to get unhinged. Or if that happens, then we're going to have a hard landing.
So it's runaway inflation or a hard landing. That's a takeaway from Nuria Rabini, the CEO at Rabini Macro Associates and co-CEO at theboombust.com. From New York City this morning, good morning. Tom Keene Lisa Abramowicz and Jonathan Ferro. Futures right now down 0.2% on the S&P. On the Nasdaq, we're down about 0.25%. Home Depot a little bit softer in the pre-market. The numbers seem to be okay though at first look. Lisa, what do you see?
Yeah, look, they look fine. They look totally decent, especially with the reaffirmation, as you said, of the full year outlook, and they beat expectations on the earnings per share and total revenues. However, there still is a decline in comparable unit sales, and this is what I'm watching. And I know that there are lots of other aspects of this, but how much of the beats that we're seeing are inflationary beats, are basically the prices going up and people still managing to pay?
That's the first look at retail this morning, Tom. We get Walmart a little bit later, 7 a.m. Eastern time, so about 40 minutes from now. Then on to retail sales data tomorrow, I believe.
In the last decade, Home Depot has been Apple without the sex appeal. They're up 20.9% per year, John, and that's after the pullback that we've seen in this recent bear market. That's a really extraordinary performance. I think it's way underestimated. I just can't say enough about what they're doing, but what's important here is they're not representing retail. They're a very different beast, John.
I'd go with that. They're facing a very, very different story compared to, say, a Walmart or a Target.
Well, or, name any of the others as well. Let's go to Washington now. It is a Tuesday across America. No, it's not the first Tuesday of November, but for the gentle lady of Wyoming, it might as well be. There's no other story in Washington. Paul Keene writes it up in the Washington Post this morning. Anne-Marie Horton joins us, our Bloomberg Washington correspondent. Anne-Marie, Paul Keene, buried in his article on Congresswoman Cheney, tries to get out to 2024 where she has a political presence. Explain to me where her presence is in the present Republican Party.
Well, she's ostracized, right? She's really a pariah of the Republican Party, even though she has voted on a number of issues alongside Republicans, whether it was against Inflation Reduction Act or abortion. These are a number of issues. She continues to have a conservative record, but she's led the charge as this top Republican on the select committee that is investigating January 6th. So she is a pariah right now within the party. She's also a pariah right now, it looks like, if you look at the polls in Wyoming. And it does look like the polls are pointing to the Trump-backed candidate that is going to take that seat that she's held. So what the zeitgeist, I guess, or the chatter in Washington is that potentially she could launch a bid for 2024.
Okay, there's 4 Democrats in Wyoming. Can she become the 5th Democrat? I mean, does she become a Democrat and run as a Democrat in Wyoming?
No, she's conservative. You need to look at her voting record.
Yeah, but there's no Democrats in Wyoming, right? There's, 3 of them are grizzly bears.
Yeah, she's incredibly conservative. But even if she was to do that, what does it matter? This is a state that President Donald Trump won 70% to 27%.
Wow.
So his candidate is likely going to succeed, whether or not, she launches a new party and picks up Democrat votes. This is Trump country.
Talking about Trump country and the former president of the United States, the latest on that is that the Justice Department has rejected or opposes the release of the affidavit in the search of Mar-a-Lago. How does that play in terms of the political narrative of what's been going on?
A lot of Republicans are calling for the affidavit to be released. News organizations were asking for it. Of course, when they unlocked the warrant, there was potential, given how unprecedented this whole situation is, maybe we'd get to affidavit. It's a roadmap. So Republicans really want it to show whether or not this raid was justified. But the Justice Department is saying that that could impact the investigation. It can also lead to witnesses that are potentially being used in the investigation, and this is something that they do not want to see. But there is still a chance it could be released, because ultimately it's the judge who released the warrant's decision on whether or not they want to release that affidavit. But it does seem like with the Justice Department, they wrote there's simply no alternative to sealing that could ensure the integrity of the government's investigation. So it does look like this is likely not going to happen, but I guess there is a slimmer chance. They also said, maybe many were talking about, maybe we'll get a redacted version, but the Justice Department said it wouldn't even be worth it because there would be so many redactions, you wouldn't even be able to understand this affidavit, which is the roadmap into understanding the theory, the thoughts behind the investigation.
What's moving the needle the most heading into the midterm elections in terms of swaying public opinion, considering that most units and most people are pretty dug in on their respective sides?
It's a great question because inflation and gas prices dominated this summer, and now you really see gas prices starting to evaporate from the news headlines. They're under $4 a gallon, much lower in a lot of places across America, and it's less of a concern going to the midterm elections. You also have some wind in this administration's back right now. They were able to get through this summer gun legislation, the Finland, Sweden, that was a bipartisan deal, the Inflation Reduction Act. These are all provisions, legislation. The fact that they were able to get gasoline prices down, they are going to run on that. So it's really going to be both sides pointing out anything they can that they did not like over the course of the past since January from either side. I think for Republicans, they're really going to lean into the fact that they think this investigation was politicized, because right now with inflation tempering a bit, gas prices tempering a bit, it might be a bit harder to hit those concerns the way they were hitting, say, May, June, and July.
AMH, thank you. Anne-Marie down in DC, TK 395. 395 is the average price for a gallon of gas in this country right now. And that's not 6. And the reason I say that's not 6 is because coming into summer, JP Morgan put out a report and said that there was the potential for this to hit 6 by the end of summer, Tom, and there would have been a big, big problem for this White House if that's where we got to. And Tom, 395 is not 6, and that is some good news. Some good news for this administration.
Some say we may reaffirm it on a demand build-up here coming down. Who knows? Picking oil prices is hazardous. John, what I would suggest again is yesterday was absolutely critical. The equity markets were on fire, pushing against the negative news that was flowing out there. And also, as you mentioned, commodities came in nicely, where you really begin to frame what, John? 375, 360 on a gallon? I don't know.
Squeezed out a day of gains, Lisa, in the face of some pretty weak economic data from China and elsewhere.
Not sure what to make of it, honestly, except that when you take a look at the Fed's balance sheet, everyone talks about quantitative tightening. Everyone talks about liquidity being drained from the system. It hasn't begun. And I think that that's an important note. I mean, yes, it's gone down marginally, but their balance sheet's still very close to $9 trillion.
I mean, what's the deal with that?
This is their schedule. It will continue to roll off as time goes on, but it has been slow. So when people talk about quantitative tightening, it has not really felt its big effect just yet.
Down about 0.1% on the S&P this morning. Good morning to you all from New York City. This is Bloomberg. Live from New York City this morning. Good morning. Here's the price action this Tuesday morning. Futures negative 0.2 on the S&P. On the Nasdaq 100 down about 0.25%. Those two up 17% off the June lows on the S&P. Up 22.8% off the June lows on the Nasdaq 100. And yesterday squeezing out a day of gains in the face of some pretty weak economic data. Empire Manufacturing here in New York and over in China. Weak data, weak data, weak data. The bond market though made a move. The whole curve shifted lower, 2s, 10s and 30s. Bit different this morning, curve inverting a little bit further. We take yesterday's move back up 2 basis points on a 2-year to about 320. Let's call it up a basis point on a 10-year to 279.51. But yields came in off the back of weak data. Crude did too. Let's look at the commodity market. I want to look at Brent. I want to look at gas in Europe. Brent crude is coming down to 94, down by about 1% today. Gas prices in Europe are not coming down at all. This is the benchmark for European gas. Prices up again today by 8%. And Tom, what you have to know about that number, and the team here at Bloomberg breaking it down, is that number is 12 times higher than the seasonal average of the last 5 years. That's what the Europeans are dealing with this summer.
And you see it in coal as well. These are spikes up, folks. These are surges. These are jump conditions to something new. But, John, what I would say on the Bloomberg terminal that I look at it every moment, its proxy is Euro-Swissy, shows strong Swissy. It's very subtle, but it's there within the European angst.
We can have this big conversation about what's going to happen in the U.S. economy. In Europe, there is no division. Pretty much everyone you speak to right now is on board with the idea that we get a recession at the back end of this year in that economy. Capital Economics off the back of the ZEW data out of Germany, that's just investor confidence in Germany rolling over. They just said it's unavoidable now, Tom, unavoidable. And in a few weeks' time, the ECB's got to sit down again, September 8th, and potentially hike interest rates 50 basis points. Who wants to be them? right now.
And I want to watch Sterling too. Sterling really can't get a bid. 120.23, John, not too far from a 119 level.
It's a tough time for the Europeans, TK, and it could get a whole lot tougher as we get into winter.
Let's stagger forward into 2023. We do this with Rebecca Patterson. She and Ray Dalio at Bridgewater are focused on inflation and the hyper reality that truffle Parmesan frites at Match 65 on the Upper East Side clock in at a $15 number. Those aren't McDonald's French fries, Rebecca Patterson, but inflation top to bottom has hit food and rent.
So I haven't had those truffle fries. They sound delicious. I'm going to have to check them out.
Check them out, please.
But the more important point for your viewers and listeners is that even though inflation may have peaked, I think the market is discounting that the Fed sticks the landing and inflation gets back to the Fed's target quickly and without a recession. That's what's being discounted. And it just seems pretty unlikely. Either the Fed is going to tolerate inflation settling somewhat higher than target, or it's going to have to tighten enough that the recession that you all were just talking about is deeper than expected, which means earnings have to come down. So right now, what we have are puzzle pieces that don't fit. Something's going to give. And we think it's probably going to be growth that surprises us on the downside, even though we're not seeing it broadly across the economy yet.
If I need to participate in the economy and in the stock market, how do I hedge into 2023? If I want to be an adult, if I want to be rational, how do you structure a hedge on equities?
You know, the risk that we think is bigger than what we've had for decades is a prolonged, and I'm using this in a broad sense, not a literal sense, but a broad stagflationary environment where growth is slowing, inflation is moderating, but from high levels and still staying relatively high. And in that environment, if you go back the last 100 years, equities have done the worst. Bonds have been sort of neutral. Your best assets to own were going to be inflation-linked bonds, gold, and to a slightly lesser degree, broad commodities. So Tom, to answer your question, if you're thinking, where do I want to be in the stock market? You want to think about the companies that can benefit from inflation that aren't going to be hindered by it, that they can continue to pass higher prices through, perhaps commodity exporters. You're going to look for companies that if interest rates do have to keep going up because the Fed is continuing to push inflation lower, that they're not going to have those longer duration cash flows that are going to be more sensitive to that liquidity draining. And as you all mentioned before, quantitative tightening, the balance sheet runoff is just warming up. September, we see that step up in the pace of QT. And I don't think people are adequately focused on what that could mean yet for the market.
Rebecca, how has your view, though, changed on commodities? I know that Bridgewater has been really bullish on commodities as a hedge against the stagflationary outlook. And here we have commodities really falling pretty significantly. How has that changed your view at a time when the 60-40 is actually starting to work again and commodities is not?
Yeah, so in the first half of the year, when we were seeing those stagflationary pressures more prevalent, you did see commodities providing you good balance to a portfolio when stocks and bonds were not working. For the last 6 weeks, we've seen a bit of an unwind of some of those trends as the market has discounted, again, that we're going to get this Goldilocks environment, that inflation is going to keep coming down, partly because of commodity prices, and the Fed is not going to have to push us into recession. So if Goldilocks occurs, which would be wonderful for everybody, I agree with you. Commodities might not benefit to the same degree as they have been. However, I think you don't want to just look at the very short term, the last 6 weeks. You want to think about the year overall and looking forward. Where are we going here? Even if demand is slowing in Europe, in the US, China, they're trying to get a nascent recovery going. Infrastructure spending would increase demand for commodities. But you got to think about the structural as well. And structurally, we're in the very early innings of a climate transition. And that is inherently inflationary. It's going to squeeze prices of dirtier sources of energy. And that is going to keep a support, if you will, under commodity prices that I think will help them continue to add balance to a portfolio if this stagflationary environment persists.
Which the stagflationary environment that you're talking about could last 3 to 5 years, you were talking about, which is the reason why Bridgewater has been so bearish in the traditional 60-40 allocation. How much conviction do you have? Has Bridgewater been adding to commodity positions in the sell-off?
I don't want to talk about specific positions. I would say that our view on commodities has gotten a little less bearish recently, very tactical, as we see slightly increased supply. But I'm talking right now not about tactical trading, but about thinking about a longer term portfolio. If you're an endowment, a pension, you have to get those returns for your constituents, for the people depending on you. You want to make sure you have balance so you aren't vulnerable over the longer term as you were in the first half of the year. And we've seen some of those fiscal year returns come in for a lot of those institutional investors, and not having that balance really, really hurt them.
Rebecca, when we used to talk about long-term investments, we'd talk about China, how it had to be a feature in your portfolio over the long term. Do you still have that view?
We still think that China gives a lot of important diversification to a portfolio. It's really interesting right now how divergent China is from the rest of the developed world. We're looking at slowing growth, high inflation, central banks tightening. They're practically opposite of that. They're trying to get their recovery going. They have lots of room to ease. We saw a small rate cut this week. They're doing fiscal stimulus. And when you look at what's discounted in Chinese equities today, I think it is valid that there is a risk premium there reflecting some of the geopolitical risk, the tensions, the possibility that trade tensions escalate from here. That's a real thing, and it should be discounted in the valuation of those stocks. But even when you account for that, earnings growth projected by Chinese stocks is close to zero. So if they can just get a modest recovery going, modest earnings growth, say 1%, it does make Chinese stocks look pretty attractive to us.
Rebecca, what about the risk that China becomes the next Russia? And what I mean by that is that they make a move on the international stage in a place like Taiwan, and there is international pressure to move away in the same way there has been in Russia this year. Now, Rebecca, I reflect on the last 10 years, and so many people are upfront about the risks around the Russia story, and yet I heard the same thing. Now, when it comes to China, do you have to take account of that, the risk of that happening, the pressure of companies exposed to China, that they would need to move out?
So we try to manage geopolitical risk like we would do financial risk, economic risk in every position we have. And one thing we're always trying to do is make sure that no single position, no single exposure, whether it's a company, a country, an asset class, could do undue harm to our portfolio. And China clearly is going to be part of that. And it's an important thing. It's in the headlines every day. We're reading about it. But it's certainly not the only geopolitical risk we'd watch. But of course, we're watching it. And of course, we want to make sure that our risk controls, the portfolio sizes we have, are going to take those sorts of things into account, again, alongside financial related risks and economic risks, again, with every country, every position we have. That's just part of our process.
It's a complex moment, that's for sure. Rebecca, thank you for your time this morning. Rebecca Patterson there of Bridgewater. TK, it's not just the economics, it's the geopolitics there too, and we're going to talk about that in just a moment.
To me, the reality is, and she was really eloquent on this, what the pressure is to quiet money, whether it's the individuals listening and watching this morning, John, or it's endowments and, more traditional money. There's a thing called the Endowment Index from Cision. Thank you for that. It's a really intelligent index. It's on the Bloomberg, and it's up 6.2%. Per year over the last 10 years, John. It's totally unacceptable. I mean, that's at least 100, if not 200 basis points below where they want to be, and that's because of recent real underperformance.
Well, things are getting harder, not easier on that front, perhaps. In just a moment, we'll catch up with Richard Haas, the Council on Foreign Relations President. And Lisa, I think China's got to be a big feature in that conversation. The weakness at home with the economy and the pressure perhaps to double down on the nationalism abroad and at home, for that matter, and you wonder whether that's the direction of travel for this leader.
On both sides, right? You've got Xi Jinping trying to get the narrative away from what's happening with the economy. And then the United States, you have an increasing number of Congress members going to Taiwan. And there's a fear that they could tiptoe into a more severe altercation.
Richard Haas is coming up in just a moment. That's a conversation you really do not want to miss. Futures right now down about 0.2 on the S&P 500. From New York City with Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro on this Tuesday morning. Good morning to you. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In Wyoming today, Republican Congresswoman Liz Cheney is in danger of losing her seat to a primary challenger backed by Donald Trump. The daughter of the former Vice President Dick Cheney is vice chair of the committee investigating the January the 6th riot at the Capitol. Her anti-Trump stance has made her an outcast in her own party. Bloomberg has learned that the Trump organization's longtime CFO is in plea talks with New York state prosecutors to resolve tax fraud charges and avoid a trial. Alan Weisselberg and the company are accused of conspiring to avoid income taxes by giving some employee perks that were not reported to tax authorities. Even if Weisselberg settles, the Trump organization would still face the fraud case alone. Here in the UK, Rishi Sunak is pledging to shake up the civil service if he becomes Prime Minister. Sunak said he would cut staff, slash some pay rewards and reduce transfers between government departments. Both Sunak and his rival Liz Truss has promised reforms to the civil service in an attempt to appeal to Conservative Party members suspicious of government workers. Bloomberg has learned that Credit Suisse is facing further delays in getting approvals for some of its operations over in China. That is after a number of senior managers left. The Swiss bank lost nearly half of the senior personnel management at its China securities venture in recent months. Chinese regulators will postpone any on-site inspection until those positions are filled. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
So much has collapsed within China that the domestic economy is nowhere to be found. Right now, the rest of the world is the only hope for China, and even that's collapsed because the latest data show the export numbers are nowhere to be found. So China really has nothing to hang on to going into the Party Congress.
Bill Lee of Milken on the edge of Bramo just yesterday on the global economy. What do you think of that, Lisa?
I thought it was fascinating. I also thought it was interesting how he said that the growth would likely be sub 3% in terms of GDP expansion in China, although no analysts on Wall Street will say that because they'd be banned from the nation.
Absolutely not. Lisa Abramowicz, Tom Keene and Jonathan Ferro this morning. Good morning to you all. Here's a snapshot of the price action this Tuesday. Futures are lower. We're down just 0.2. A softer start to this morning, just slightly. A mild move lower. We're negative 0.2 on the Nasdaq 100 as well. Yields unchanged, 279.14. We had Home Depot numbers a little bit earlier this morning. Tom will get Walmart in about 12 minutes' time.
Looking for that, different than Home Depot, but nevertheless important. I'd also note Chinese renminbi out to 6.79, rounded up on a waltz towards 7. Weaker renminbi off the economic challenges. This is a joy on radio and television, and for those of you on digital as well, in its entirety. Richard Haas of the Council on Foreign Relations. We celebrate his new book coming out on American citizenship. We'll look for that in January. I'm told the movie rights have been sold. Brad Pitt scheduled to play Richard Haas here. The Bill of Obligations, the 10 Habits of Good Citizens. But, Ambassador, I really feel strongly we need to switch to what you built at the Council on Foreign Relations. With Elizabeth Economy and David Sachs, you have been definitive in the last 3 weeks on China. Nobody's done it better than you on your website. I want you to synthesize together all you and your experts have learned about how this president of China gets from Pelosi to the Party Congress.
Well, his challenge, Tom, is that what's worked for China for the last 3 or 4 decades, not just for Xi Jinping, but for his predecessors and for the Communist Party, has been the deliverance of high levels of economic growth. That was the basic bargain with Chinese citizens. You don't worry so much about political rights, but we'll give you an ever-improving standard of living. The problem for the Chinese, though, is that now, because of everything from their own economic mismanagement to COVID, the mismanagement there, to supply chain issues, you name it, the leadership cannot deliver that anymore. And the question then is, how do you justify a country of 1.3 billion being run by 90 million, which is the Communist Party? And my concern, and I think a lot of observers' concern, is that increasingly the substitute is going to be nationalism. That explains not what I would call the reaction, but the overreaction to the speaker's trip.
What I see, Ambassador, is we're all looking through the rose-colored glasses of having to have read 800 pages of Jonathan Spence years ago. The fact is, Elizabeth economy is written like no one on the fragility that he may face at the party conference and at the federal level. How fragile do you believe he is as he goes into these important meetings?
I actually don't think he's all that fragile. If you think about the anti-corruption drive, Tom, whatever impact it had on corruption, what we also know is it had an enormous impact on removing any opposition to Xi Jinping. So my sense this November, it may be not a 100% complete coronation, but he's going to get that third term. There may be some limits on his sole leadership, but I think it's a pretty safe bet. The odds are extremely high that he will get a third term and conceivably even more than that one day.
Richard, you've been a leading voice on this, and I think it's so important to go over what you just said moments ago. That's political legitimacy through nationalism and not through economic stability. That's a change, a shift. And Richard, I wonder what you think that looks like through the next couple of years and what we need to be wary of.
Well, it worries me, Jonathan. What it looks like, and we're already seeing it, is China's established a much more muscular baseline against Taiwan. What they've been doing in the last few weeks, which, by the way, was being developed over the course of months and years. It wasn't a spontaneous response, far too elaborate, far too large. Well, that's now become the new normal. We're seeing a much higher level of exercises, many more encroachments into airspace and sea space near Taiwan. China's been building up its military for years. My guess is one of the lessons of they'll take from the Ukraine war is they've got to build off certain types of conventional forces, also their nuclear forces. They will conclude from Ukraine that the reason the United States has not gotten directly involved is because of Russia's enormous nuclear arsenal. Watch China's nuclear expansion. It's going to be robust. So my sense is over the next few years, they are going to increasingly fill out their military strength. They're going to demonstrate it in the hopes of intimidating others. Ironically, Jonathan, it could well have exactly the opposite effect. China's foreign policy has been, is, and probably will be heavy-handed. And what they're doing is increasingly turning up the level of alarm among its neighbors, above all Japan, to some extent Taiwan, Australia, obviously the United States. That's where we are.
Richard, one speculation has been that perhaps it won't turn into a hot war in the very near term, but you will see China clamp down and isolate Taiwan, basically not allowing exports or imports at a time when Taiwan is the main exporter of semiconductor chips. This is a major potential risk to the global economy. How realistic do you see that as an outcome that could plausibly happen, and what's the U.S. response?
It's a good point, Lisa. We're already beginning to see certain economic sanctions against Taiwan. And Taiwan, Japan, South Korea, and others have made, I think, a terrible strategic error. They have allowed themselves to become overwhelmingly dependent on their need to export to China and their need to import from China. This gives then China enormous leverage over its neighbors. So one of the real challenges, I would say, going forward is whether China's neighbors begin to reduce their trade dependence on the mainland. And then, yes, as you suggest, we've also got a race here in the semiconductor world, whether we can somehow reduce Taiwan's centrality, not by doing anything to Taiwan, by increasing our own capabilities and that of others. But my hunch is that's a project of years, not months.
Richard, we really need to continue this conversation another time. It is so important. And again, you've been a leading voice on it. And I've followed you over the last couple of weeks after that trip from Speaker Pelosi to Taiwan. And I think this is going to be something we all need to pay attention to. Richard Huss there of the Council on Foreign Relations. Lisa, this story's not going anywhere. I keep bringing up multinationals who have had one foot in China, one foot here in the United States, and try to satisfy a progressive consumer base in, say, America. and trying to impede a dictatorship abroad. That is going to be very, very difficult, more so in the months and years ahead.
And I wonder how much we start to see in the earnings reports, companies, multinationals moving away from China quietly. They don't want to come out and say we are leaving some of our mainland exposures and production because they would incur the wrath of the Communist Party. However, you are seeing a decline when it comes to exports to the United States. That's actually underneath the data. I do wonder how much that continues.
Hey, Tom, look, Richard said it. China's whole goal essentially has been to maximize the dependency of others on them and minimize the dependency of them on others. And Tom, we've seen people write about this, Kevin Rudd, Richard Haas. This story's not going anywhere, and people have got to respond to that eventually.
Well, that's the model for export-import. I'd go domestically here, as Ambassador Haas talked about at the beginning. Their sole model is their bargain with the people. We will employ you, leave the politics to us. And that is, if it's not broken, it's breaking.
Futures right now down 0.2 on the S&P 500. Walmart numbers just around the corner. We'll break them down for you right here on Bloomberg TV and on Bloomberg Radio.
It's really demand-driven inflation that we're dealing with, and that is something the Fed can, in fact, handle.
I think the market is pricing in this very specific outcome where we head into a very moderate or mild recession.
Our view is that it may be a soft landing for the labor market.
There's a lot of talk about US recession risk, but the truth is the problems seem much more gloomy in Europe.
If we look at the rest of the world, there's just a world of trouble out there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
That was a cheery opening, wasn't it, from New York City this morning? Good morning, good morning. For our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance. Futures, negative 0.25% on the S&P. TK, Home Depot earnings about an hour ago. Walmart numbers any minute from now.
Yeah, we're looking for them to come out right now. Let's see if they're rolling out. No, they're not. We'll have to see. They're delaying. They're like the big banks now, John. They're delaying. They say they come out at 7, but...
They're lying to us, misleading. What did you make of Home Depot 60 minutes back?
What I made of Home Depot is they're doing what Home Depot's done forever. I'm sure Ken Langone would come on and pound the table about we do it right. There we go with Walmart coming out right now. Revenues a little bit better than the estimate. Comp sales 9.5%. Again, that's within a huge inflation. There's comp sales, John. I love this. Ex-gas up 7%. So the first look there at a outlook for the back half of next year. They maintain their outlook. I don't know what the outlook is.
Well, it's the outlook I keep going for, because these retailers, Walmart, Target, Lisa, they've had to cut their outlook a million times. They come out with their outlook, then a few weeks later they cut it, and Walmart coming out this morning and maintaining their outlook for the back half of full year 23.
You are seeing a pop in the shares ahead of the market open, up about nearly 2% after reporting better than expected earnings. How much are we seeing companies across the board lower expectations again and again as they revise lower before they put their earnings out, and then they cross that very low bar in order to give a better sense? I mean, honestly, if they affirm their projections going back to 2023, how solid is that? I mean, what's going to change between now and next month that could potentially affect that?
What did you make of that over the last couple of months, Lisa? The fact that they come out with an outlook and then a few weeks later, seemingly they cut it?
I view this as trying to hedge against the liability of being accused of a lack of transparency. They're going to be over-transparent. They're going to say things are looking okay, but when they don't, we will let you know. And that's basically how I view it. I wonder if investors basically take the forward guidance as less solid than they have in the past.
That was diplomatic. You tried. The stock's up by a little more than 2% in the pre-market. We'll bring you a breakdown of that in just a moment. Futures look like this, down 0.25% on the S&P 500. On the Nasdaq, we're down 0.25%. Also, yields unchanged, 279.32. In Europe, you're looking at really, really soft investor confidence out of Germany. Euro dollar negative 0.33% at 101.32. In Europe, gas prices are higher, but crude is lower, and crude lower over the last couple of days to kick off this trading week, Lisa. $89 a barrel on WTI, down about 0.5% this this morning.
How much does that support retail sales that we get tomorrow? How much is that supporting some of the momentum that we get from the projections from a whole host of retailers, including Target, which reports tomorrow? Today, we did get Home Depot at around 6. Walmart just crossing. You can see year to date, the performance is pretty dire. Home Depot shares down 24% and Walmart shares down a little more than 8%. What we see in Home Depot is you do see an increase in revenues, a beat across the board. However, you are not seeing an increase in traffic. In other words, the actual individual sales are not increasing. How much is this an inflation story? Walmart coming out, they actually saw a lesser loss in terms of earnings per share gains or earnings per share year over year performance. So this is better than expected. However, they are dealing with a very difficult moment, especially with the types of things that people are buying, which are shifting very quickly. At 8:30 a.m., we get July housing starts and building permits. This follows what we saw yesterday, a massive plunge in the home builder sentiment on the heels of where we're seeing mortgage costs, the fact that rates have gone up so much. Do we see housing starts slow down as a result? This is really the push-pull in the housing industry. How much does the lack of supply end up propping up prices for longer than people can stand it? And at 9:15 a.m., we get the latest read on auto manufacturing, July industrial production. And John, I'm looking for a sense that to confirm what we saw in the Empire Manufacturing Survey. Was that a one-off, the second biggest plunge in terms of Empire manufacturing sentiment going back in data to 2001? Do we get a reconfirmation of that in the auto sectors and other manufacturers, especially ahead of the next ISM read?
You notice how the pandemic broke the chart? It always does. Every single chart we have, the pandemic just breaks the chart.
Yeah, and right now we're seeing some volatility that starts getting close in certain metrics, and that I think is fascinating.
Ramo, thank you. Decent day ahead. I'm not going to say big day ahead, Tom. I don't even want to say big week ahead. We're light on economic data. We've got retail sales, got a bit of Fed speak here and there, some Fed minutes, Tom, coming up tomorrow.
I think a lot of it's the earnings story and what the stock market's doing, John. As I say, I think yesterday was crucially important for the stock market. Everybody's going to readjust to that. Buried in the Walmart release, John, and it's not a clumsy release, but there's not a lot of percent clarity in it. But two inside baseball things are Walmart, their gross profit rate, the margin, I believe, was down 132 basis points, 1.32 percentage points as well. And I love this language, John. Just one expense idea. This is a new phrase. I've never seen this, John. Wage investments.
Could you one day, Tom, write an article on the press releases that you do like and the press releases you don't like?
What I like is
based
they
on
get
the
better.
font, the style, the graphics.
Well, no. Usually if the form and the style isn't there, it's because they're trying to hide something. That's usually the case. What I want to see, John, is a trend towards clarity, and particularly the big banks, they're dramatically clearer than they were 5 or 6 or 7 years ago. And I want to, I'll be honest, folks, with the power of Bloomberg, we talk to these people and they really want to know, John, how to make it clearer. Mostly speak English.
Well, let's speak English right now. We can do that with Anastasia Amoroso, the Chief Investment Strategist at iCapital. Anastasia, the S&P up 17% from the June low. The Nasdaq 100 up close to 23% from the June low. When do we stop calling this a bear market rally?
Well, maybe right about now, John. And I think the market probably does not move materially higher from here. I think 4,300 will likely continue to be a resistance. But probably the biggest takeaway is that maybe we don't have to retest the lows that we have seen of 3,700. And the reason I say that, I think there's enough that's changed fundamentally to justify that. The reason why we were back at 3,700 is we worried about the Fed depressing valuations, and we worried about the types of cuts that we need to take to the next 12 months of earnings or 2023. And as we look around today, as inflation is easing, it's giving the Fed more wiggle room. So perhaps they don't have to continue to depress those valuations, because even if they hike 100 basis points, Tom, that's already baked in.
Anastasia, the continuum here of the inflation curve is a complete mystery. There's a couple kinks. We don't know where it's going to stop along the way. Maybe it's a glide path to 2-3%, whatever. If inflation in the U.S. and globally comes down more rapidly than the wisdom, what does that do to your stock market call?
Well, I think it props it up significantly. I mean, we were just talking about Home Depot and Walmart, and this would be the types of stock that I would not be bullish on in this environment. However, if inflation does ease up and all of a sudden consumers have more wiggle room in their budgets to spend on things that are not just essentials, then that props up that sector. if inflation eases up and the Fed eases up as a result of it, then we could expect more from technology shares, from the high growth stocks, and so on and so forth. So I think that's a very important dynamic. But I think, Tom, in order for us to materially break above 4,300 and for us to work our way higher, we need to see earnings revisions actually turn the other way around. The reason why I say 4,300 seems to be the cap is because it's based on that $240 of next 12-month earnings and a multiple that's somewhere around 17.5 times. How much more we're willing to pay. Yeah. I think the Fed would probably need to ease up on policy a lot in order for us to justify paying more. And, how much can economy accelerate to justify higher earnings? I don't think that's the outcome right now.
That's exactly where I wanted to go. Do you think that it's too cute to believe that the Fed is going to push back against the essentially easing in financial conditions that we've seen over the past few weeks?
Yes, there's so much talk about that. And first of all, if you look at the easing of the conditions, most of that occurred in equities. And if you look at something like the Goldman Sachs Financial Condition Index, it certainly eased up, but it's still well off where it was just in the beginning of the year. And it's roughly at a 20-year average. So I think, yes, there's been easing on the market, on the margin, but it's not been that significant. The second thing that I would say is I think Fed Chair Powell actually outlined a pretty good reaction function. First of all, he said that they want to be a little bit more cautious as they get to neutral, and we're now close to neutral. They also want to be a little bit more cautious because they know that the tightening that's in the system acts with a lag, and we put a lot of tightening, and he said these words, that there's more tightening in the pipeline. So let's just see how that plays out. And then the third part of this reaction function that he's outlined is if inflation continues to surprise to the upside, we will do more. But if it doesn't, there's probably a case for us to do less. And, to Tom's point, we are chipping away at more and more pieces of the inflation puzzle. So I think against all that, the Fed can actually maybe let the financial conditions ease up a little bit and still do a little bit less going forward.
Lisa, did you hear what I think I heard, which is Chairman Powell did a good job? Did you hear that?
Yeah, that basically...
I think a guest actually just said Chairman Powell did a good job.
I think that she's not alone in thinking that. Some people think that the ambiguity or just sort of holding the line is the way to go.
Anastasia Amoroso of iCapital. Tom, that was on the edge of you.
It was.
Chairman Powell's doing a good job.
I believe that all the central bankers, given an historic medical event, are making it up as they go. I can't say that enough.
You're just being nice to your friends ahead of next week in Jackson Hole.
That's it.
So they speak to
the
you
chairman
and
I look. I mean, folks, here's the way it is. Before the chairman gives a speech, and to be honest, I'm on a plane, I believe, before he gives a speech. I can't remember the schedule, John. But the fact is, he and I will be at the Pioneer Grill, and they've got their acclaim. It's like a full English, John, except it's a full Wyoming. And, Chairman Powell and I will dig into it. And
just to be clear here, you're flying into Jackson Hole, Tom, and you're leaving before the chairman delivers the speech.
I can't remember the schedule. Michael McKee's expert on that.
Okay.
All I know is I waved to the big grizzly bear. There's an 8-foot grizzly bear, folks, and you sort of wave as you go by and honor Villa.
We'll get a family photo in front of that grizzly bear.
Yeah.
It's appropriate for this program.
Adam McKee tried to interview the bear once.
We'll all be superimposed in.
Well, you're going to be alongside us, Brown.
John, McKee tried to interview the damn bear once, except it was 2 a.m. He couldn't get Micah to help him.
I don't want to know how that night was going. Mike Bowler, JP Morgan, is going to join us a little bit later this morning. We'll do that in the next hour. Bank of America pointing out we're no longer apocalyptically bearish.
There you go.
Okay, all right. We got to talk about this.
I love that.
I can't spell it.
We'll do this in a moment. We'll catch up with Anne-Marie Hordern down in D.C. All of that
She's
coming up.
Apocalyptically.
This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Iran is signaling that it may be closer to a deal with the U.S. that could restore Iranian oil exports to global markets. Tehran has sent the European Union its response to the bloc's proposal for reviving the 2015 nuclear accord. The government expects to hear back from negotiators in the next few days. Singapore's Prime Minister in waiting, Lawrence Wong, warns that the U.S. and China may sleepwalk into conflict over Taiwan. Wong spoke in an interview with Bloomberg editor-in-chief John Micklethwaite.
We are starting to see a series of decisions being taken by both countries that will lead us into more and more dangerous territory. And you could easily see near misses, accidents happening around Taiwan Straits, around the South China Sea. It has happened before.
Meanwhile, tensions between the U.S. and China remain elevated. On Monday, Beijing announced new patrols around Taiwan following the arrival of another U.S. congressional delegation. Shares of Home Depot are lower today. The home improvement chain reported that customer traffic continued to decline in the fiscal second quarter, and customer transactions were down 3%. That's from a year earlier. Home Depot's comparable sales and profits, however, did beat estimates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Supply shocks are always tough for the Fed, but contrary to the view that supply is the driving factor right now, our numbers are telling us it's really become demand. As this year has gone on, it's really much more a demand-driven inflation that we're dealing with, and that is something the Fed can, in fact, handle.
Peter Hooper there of Deutsche Bank from New York City this morning. Good morning, Tom Keene, Lisa Abramowicz and Jonathan Ferro. In just a moment, we'll catch up with Anne-Marie down in D.C. Here's a snapshot of the markets. Futures down by a little more than a tenth. No drama here on the S&P. No drama on the Nasdaq either. The Nasdaq 100 negative 0.12%. Yields up a couple of basis points on a 10-year, 280.59. Crude now unchanged, $89 and about 41 cents. I promised you that note from Bank of America. Every month they do this global fund manager survey. You ask fund managers a bunch of questions, then Michael Hartnett offers you a little commentary around it. It's a great note. They say the mood is no longer apocalyptically bearish. They go on to say the following, though, and I think it's important to recognise this. Sentiment is still bearish with the cash levels where they're at right now. Too bearish, Lisa, for the immediate reversal of the bear rally.
Yeah.
A lot of bearish and bearishness in there, but I think you get the point.
Basically, people are not positioned for this rally to continue. Basically, that is leading to people to believe it can continue for longer because people haven't thrown in the towel and just gone all in. I love the idea that apocalyptically bearish, the fact that that's no longer on the table, doesn't mean bullish.
Well, cash levels have dropped. I think cash levels is what they point to.
6.1% to 5.7%. The still crowded, most crowded trades, they still see as the long dollar. I thought that that was very interesting. And the biggest tail risk was protracted inflation. And to me, this is the big shift in sentiment right now, John. It is, are we seeing a true abatement of inflation, or are we seeing a head fake driven by some of the commodity action?
And Tom, you've talked about it. We come down to what? 8, 7, 6, 5, 4? Where does it go?
You know, the smartest mathematician I've heard in this is the mathematics expert Anastasia Amoroso. And what she did, John, is she said, look, here's where we are, and maybe we won't retest the bear market lows. I mean, take what Anastasia said there in English and all this other apocalyptic stuff, and everyone is going to rationalize up 17%.
Tom, that's the good news. We're no longer apocalyptically bearish. That's the takeaway.
Yeah, but what's important, and this is where Bank of America agrees with J.P. Morgan, there's still a huge amount of statistical negativity out there.
Oh, for good reason, Tom. Some of the data points still aren't pretty.
Yeah. Are we done?
Very much so.
Anne-Marie Horton joins us now, Bloomberg Washington correspondent. She wouldn't know a bear market low if it hit her. And so we're thrilled that she joins us this morning. Anne-Marie, in the blur that's out there, the news and the non-news, there seems to be a center tendency written by a lot of experts on the Espionage Act. And it is of another time and place, World War I. And I guess we're going to learn more about it as we go. I like what the New York Times says, Julian Barnes today, about spies and unauthorized leakers. Help me with the legal effort everyone's going to need here to frame a law that's 100 years old.
Well, I think part of the problem, Tom, too, is the fact that when we know what we know so far is that it involves this potential use, or rather the fact that it went against the Espionage Act, right, and issues of national security. But I think until we really see the affidavit, if we ever see it, there's going to be a lot of questions regarding what they can actually use in terms of bringing against a case against the former president.
Anne-Marie, we were talking about how energy prices have really underpinned some of the optimism that you're seeing in markets as this feeling of disinflation starts to percolate, and today's latest disinflationary move is an increasing feeling that Iran is going to sign some sort of accord with the U.S., bringing some of that supply back online. How close is that?
Well, they've been trying to do this for 18 months. And while, yes, Iran has sent a response, it was supposed to be the, quote, final text. That's what the Europeans are saying, which are acting as these interlocutors between Tehran and Washington. But then the Iranians have a response, which likely looks like it includes changes if you look at what's being reported in Iranian media. So that does not mean that this is the final text. We heard from the Iranian foreign minister yesterday, Hossein Amir-Abdollahian, which a lot of people in the oil market said that looked positive because he said we've made a number of changes to get a number of changes back. So it looked like the Iranians were giving in to negotiate. But at the end of the day, if they are coming back with changes and the U.S. State Department is saying what can be negotiated has already been negotiated, it looks like they are still at a standstill. And this has been going on for 18 months. So while, yes, we are, quote, close maybe to a path forward, not exactly sure we can believe that until it is finally done.
And
because we've heard this again.
And Marie, how much is this particular kind of accord part of the plan of this administration to bring oil prices down even further, as they've been saying over the past few weeks?
Well, at the moment, the administration is very happy. You could look at all their tweets and all their messaging when it comes to gasoline prices. Obviously, if there was a nuclear deal and you were to see more Iranian crude back on the market, that would help coming into the winter months when those EU sanctions on the transportation of Russian crude are really going to start to bite. Also, they have to take into consideration, potentially you'll see more Chinese demand if they start coming out of some of these lockdowns and start easing up some of this COVID-0 policy. But before oil prices dominated a lot of chatter in the West Wing, there's always been a idea to re-engage and get back into the nuclear agreement. The president now, Joe Biden, but then the candidate was campaigning on this, and they think this is the path forward to stop a nuclear Iran. So oil prices for sure plays into the factor now because it's timely, but they always wanted to get this deal over the finish line. The issue now is how much political capital this administration wants to use at a time when, I mean, Iran says they have nothing to do with the recent attack against Salman Rushdie, but of course there was a fatwa against him since 1989. We have a plot that they wanted to kill the former National Security Advisor, John Bolton. There is a lot of sentiment right now that doesn't look so friendly on Iran. So this is going to be difficult for the Iranians to try to get any more out of the United States, given the political environment.
MH, thank you. Anne-Marie, down in Washington. And just to pick up on the gas price story, Lisa, it's quite a stat that we are down every single day since the middle of June, and here we are in the middle of August.
It's notable, especially when you travel around and you see how much it's basically, we've got a billboard advertising inflation, which is at every gas station, and how much it has come down. And we saw that in the sentiment survey. UMich, no one's talking about anymore because it turned around. And how much is it really on the backs of what we're seeing in gasoline prices?
We'll get back to the old days when no one really talked about it.
Yeah, basically, that's where we're headed.
It was something we talked about, but just something we didn't really talk about. Home Depot, Tom, is negative about 0.7% in the pre-market.
Writing, Joe Feldman just put out his note before the conference call. He notes operating margin expansion. I thought all the margins were going to contract.
Lisa's going to run through those numbers in just a moment. Walmart up by 3.6% in the pre-market. On to retail sales tomorrow. From New York, this is Bloomberg. We're still bearish, just not apocalyptically bearish, just too bearish to expect an immediate turnaround in this bear market rally. Tom, the words of Michael Hartnett over at Bank of America. Don't ask me to repeat that. I'll stumble twice more.
Please don't.
Futures, negative 0.06% on the S&P 500. On the NASDAQ, we're negative just a little bit. The run, though, pretty tremendous, up by 17% off the June lows on the S&P, up by close to 23% off the June lows on the NASDAQ 100. What does that mean for the market going forward? Just south of 4,300 at the close yesterday. And Michael Hartnett of Bank of America saying they want to look to fade this around 43.28. Very, very precise stuff. We're not that far away from it right now. Off the back of some pretty weak data yesterday, we managed to squeeze out a day of gains. Their base case, though, over at Bank of America is still rates up Rates up and profits down, and that's going to be toxic for this equity market. In the bond market, I want to look at 2s, 10s, and 30s. The expectation at B of A is maybe we get another big move at the September Fed meeting. Citi looking for another 75. Citi still looking for 4% on Fed funds at year end. So there's something to get your hand around. Right now, your 2-year is at 321.36 and up about 3 basis points. Your 10-year, 280, up around 2 basis points. So the curve, a little bit more inversion there, something like -41, -42 basis points on the session so far. That's where the curve's at, 2s versus 10s. Want to finish on commodities just briefly and talk about what's happening in Europe. Gas prices are still climbing by 8.7%. And if you missed this statistic in the last hour, I'll give it to you again. Where we are right now on benchmark gas prices in Europe is 12 times the seasonal average of the last 5 years. Tom, what a difficult spot that European economy is in.
It's a huge spread here. And, you know, I'm glad you bring this up, John, because I'm more focused on the stock market in the U.S., but this euro thing is really evolving. And I believe we could say, John, it's revolving. It's evolving quickly.
Yes, Tom. And I have said repeatedly that the debate around the Fed is really divided. Around the ECB and the European economy, it's very one-sided. A lot of people expecting them to go again, 50 basis points in September. Into weakness, Tom, into real weakness in that European economy. I said it earlier, I said again, Capital Economics calling it unavoidable that Europe experiences a recession at the back end of this year.
When's the next ECB meeting, do we know?
September 8th.
Oh, look at you.
It's
You're
in the
just a
diary.
font of wisdom.
I am, Tom, on the ECB.
I'm off that
basically
day.
Nothing else.
I'm off that day.
Are you? You taking that day off?
I got to take that day off.
Good for you. What
it's
are you doing?
Afterthough's first day of school.
Okay. Do you want to do this publicly
She
on
doesn't
live
want me
on
to
TV
go.
and radio?
No, she's like, you know, you don't need to take the day off. You know.
Why doesn't she want you to go?
She doesn't want to be seen with me. She walks 15 feet in front of me.
So why do you insist on going?
Because that's what you do.
Okay.
You walk 15 feet behind and be sure they have money for some stupid, overpriced Taiwanese, Chinese tea latte thing at the end.
Okay. You sound upset about this.
Yeah, well, you know.
Should we move on?
The CEO of Starbucks called her up yesterday and thanked her.
Bramo's very, very keen to talk about Disney.
Please.
Zoom and Compass.
Literally anything else.
Don't leave her waiting, Tom. Let's get to those names right now.
Her kids walk in front of her, too. She knows.
Hey, Lisa.
Honestly, hey, John, I love it when I'm just wondering whether everyone still realizes we're still live. Disney, I'm looking at because yesterday, Daniel Loeb, the activist investor, took a stake in Disney. He is arguing for them to spin off ESPN+. Those shares up almost 0.8% ahead of the market. Zoom plunging after Citi changed their rating to a sell from a neutral, from a hold, down 3%. Basically, Citi saying that there isn't that much in terms of prospects for growth. And Compass, fascinating story. This is one of the fastest expanding real estate companies in New York for a long time, hasn't really made money. And we're now seeing those shares lower by 11% after the company said yesterday they're really struggling given where the real estate market is. They're facing massive job cuts, trying to figure out how to right size going forward. The story of the morning is very much in the retail sector. So let's take a look at that Home Depot and that Walmart share split, because that's what we're seeing. A split, a diversion in terms of the fortunes. Home Depot shares down less than it was before, down by 0.6% after reporting better than expected earnings. But it was the traffic story that really got people's attention. You are not seeing an increase in transactions. You are seeing an increase in revenues off the heels of inflation. This is getting people a little bit concerned about how long this can continue. This is a stagflationary type of environment. Walmart, a very different story. Shares up more than 3%, crossing a very low bar, basically saying, look, we had expected our earnings per share to go down by 11 to 13%. Now they're just going to go down 9 to 11%. And everybody is getting very excited. You're seeing that read through with Target shares up 1.7% on the heels of that Walmart projection. Target reporting earnings, Tom, tomorrow.
Lisa, thanks so much. Let's get right to it. Mark McCormick with us, Global Head of FX Strategy at TD Securities. I was making jokes about it, Mark, but there's no joke about September 8th and the challenges for Christine Lagarde. If I believe in weak euro, am I more focused on the dollar dynamics and euro dynamics of Jerome Powell or Christine Lagarde?
You're focused a little bit on both, but most importantly, you're focused on the global growth story. I think that's one of the things that people kind of miss. It's like ECB, Fed, which one should we be watching? I think most importantly, you should be watching global data surprises, and how the global economy evolves. But I think in the near term, the thing you want to focus on, and you already mentioned it, is the energy story in Europe. We're still dealing with a massive negative terms of trade shock across Europe. And what it's doing is it's weakening the growth story. It's weakening the European impulses. And I think that what that does is it puts the pressure back on which relative central bank could do more in the short term So it still lends to a stronger dollar, and it still pushes euro dollar lower. We're probably going to retest parity, maybe push below it in the next couple of weeks. But again, the biggest tension for the Eurozone is the global economy plus the idiosyncratic European energy shock, which is still kind of festering through the economy right now.
Gas prices up, weakness in the Chinese economy. Mark, they're leveraged to both. This is messy. Mark, do you think this ECB can keep hiking into economic weakness?
Yeah, I think they have to. I think, again, a big part of it is they have to kind of stabilize inflation expectations, and using the euro as part of the anchor of tightening financial conditions is also important for kind of reducing the ability to kind of maintain credibility on the inflation side. It's kind of what the Swiss National Bank did, is they basically came in and they're going to use the currency to tighten financial conditions and get ahead of the curve. So the ECB still has to use the euro as an anchor. It's just, and again, this is probably why people are confused why the euro's a bit durable. Euro was at 103.50 just a week ago in the backdrop of all of this. So I think the euro is probably even a little bit stronger than what people would hope. But I think a part of it here is the ECB still has to anchor rates, and they still have to keep rates relatively high to stabilize the euro, because a weaker euro actually creates more inflation.
That's if you believe that higher rates from the ECB lead to a stronger currency. Mark, that's not happened with the Bank of England and sterling. Why would it with the ECB and the euro?
Well, I think a good point is it's about relative expectations. The market was very bullish on how many rate hikes they thought they were going to get from the Bank of England. And basically, the growth story has deteriorated so rapidly in the UK that, relative to our expectations, and I think where the market's moving, is that the Bank of England's not going to deliver. Basically, you've got probably 50 basis points more priced in more than what they're going to deliver on. And I think for the ECB, the market was a little bit more complacent, and the ECB's kind of outperformed a little bit, at least over the last couple of months, delivering some hikes. And then again, you do have what I think are important nonlinearities that reserve currency, reserve managers. Looking at Europe with negative interest rates is not very appealing for central banks and reserve asset allocation holders. So if we do kind of think about relative euro sterling, there's been more disappointment on the UK side. The Bank of England has more room to price out what was priced in earlier. And the ECB, I think, is kind of at least kind of maintained what they should have done and maybe over-delivered relative to where pricing was a couple months ago.
It's fascinating to me, Mark, that the calls that you have usually are spinning away from the dollar. I've noticed that they're crosses that are not having to do with the greenback. How much is that by design? Because the dollar is going to be a risk-on, risk-off trade that is somewhat divorced from some of these other fundamental characteristics.
Yeah, I think what's interesting is that where the peak U.S. inflation themes interesting, because what we're doing is we're seeing less volatility. We're seeing volatility come out of FX. We're seeing volatility come out of rates. So the market is kind of exploring a EM-based carry trade. So the Mexican peso looks relatively upbeat, and some Latin American currencies look upbeat. Some of them are being simulated and supported, like Chile. But there is this little narrative that's happening right now that is we're kind of evolving out of peak inflation and peak Fed pricing into something that's not super bearish for the dollar, but people are exploring where there's too much risk premium and where we do have carry. I think in the G10, though, we're still in the same trade, which is there's too much idiosyncratic risks in the Eurozone. We do like selling euro NOK Norway into the Norges Bank, again, because we get another rate hike. We've got a country that has pretty strong fundamentals. The currency is extremely cheap in terms of the way we look at Norway relative to the macro story. And I think what we're doing is we can kind of unpack the dollar a little bit and look for some idiosyncratic risks. Like our EM team is long Indonesia, which is another interesting story when you look at equity flows and how things are evolving in certain parts of Asia. So I do think it's time that we could explore another regime change, or at least another shift in the narrative in FX with peak dollar coming in 2023. But right now, looking for things that look a little mispriced against macro stories.
Well, at least foreign exchange isn't boring anymore, Mark. We've said that a few times over the last few months. It was for a long time. Mark McCormick of TD Securities. It is not now. At least euro dollar, 101. Where are we now? 101.28.
Yeah, 101.28 after a complete round trip. And I thought it was interesting that as you got this disinflation story in the U.S., you saw euro dollar actually gain quite substantially. And that's why I was wondering whether this is just a pure risk on, risk off kind of feel that's really driving this story more than what the ECB can potentially do to stave off some of these declines.
Did you see the data out of the UK this morning? Oof, Tom, real wage growth in the UK.
Missed it.
Brutal, big drop off, super negative. The worst kind of move. And it speaks to what people feel in the economy.
Yeah, and what's interesting here, in the phrase John perfectly said, in the economy, I think the media grossly conflates that all these economies look the same, and they don't. So when you tell me the real wage in England is challenging, I take that back to Clement Attlee in the 1930s, and it wasn't pretty.
The energy price story, Tom, is not pretty in the UK. It's not going to be pretty in Europe. We're seeing that in gas prices again this morning. I mentioned the ECB September 8th, the Bank of England September 15th. So that's one for the diary too, Tom.
Yeah, it's good. I think I'm off that day too.
You're taking that day off as well?
Yeah.
You taking some time off finally?
No, I made a decision to really not take off a lot of time this summer. I just didn't want to do the tourist travel thing. I just
why is that? You didn't want to take advantage of euro dollar at parity, TK?
No, I just can't do the wait in line at whatever for 4 hours thing.
Just not interested in that?
No, I just don't.
At the airport? Is that the problem? Getting through
I was
security?
thinking about a cigar store down from Rudolph.
Just Portage in the Adirondacks. You're good.
Oh, yeah. Can you see me in the black flies?
Yeah. I can see you hiking, Tom.
We're
doing a family hike in Jackson Hole next week.
I'd get an Ithaca 37 out and start
family
shooting
hike,
the black flies
pictures
down.
with the bears. It's going to be a great time.
Oh, yeah.
From New York in Jackson Hole, Wyoming next week. It's a great promo running at the moment. Look out for it. Thursday and Friday.
What's going on over there?
I have no idea what's
I'm
happening.
lighting a Coleman stove.
Okay, we have to go. I'm told we have to go. Futures down a tenth. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Second quarter profit at Walmart beat Wall Street's lowered expectations. Earnings were announced 3 weeks after the retail giant cut its annual profit forecast for the second time. Inflation is forcing shoppers to spend more on essential goods. That is leaving less money to buy general merchandise, which is usually more profitable for Walmart than its groceries. In Wyoming today, Republican Congresswoman Liz Cheney is in danger of losing her seat to a primary challenger backed by Donald Trump. The daughter of the former Vice President Dick Cheney is vice chair of the committee investigating the riot at the Capitol. Her anti-Trump stance has made her an outcast in her own party. Now, the price of zinc surged today. One of Europe's largest smelters has announced it will halt production on September the 1st for care and maintenance. The Boedel smelter in the Netherlands had been operating at a reduced rate because of soaring energy prices. Zinc has a number of industrial uses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The Fed's problem is they don't have a choice. The inflation mandate requires action, more action. The market does what it does. The concern is that as soon as the market thinks they might have done enough, that's when you look at it and you think, no, they just haven't. Not until the data improve.
That was Kit Jukes. Awesome to catch up with the chief FX strategist at SocGen yesterday. From New York City this morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures are down by just 0.1% on the S&P, down 0.1% on the Nasdaq 100 as well. A long road still to the September 21 Fed meeting. We've still got another payrolls report. We've still got another CPI report, which I believe comes September 13th, Tom. And we've got the Jackson Hole, Wyoming Symposium next week. So a lot still to come.
We hope that for all of you on radio and television and in writing, Bloomberg is a font of economics as we move to Jackson Hole. We have a full court press on this. Thrilled to see Sir Howard Davies' essay in The Guardian a few days ago as he tries to move forward the debate on the Bank of England. We'll take an international take on Jackson Hole. Today we do so with one of the most gifted people in modern economics. David Wilcox is out of Williams and the Massachusetts Institute of Technology. He, of course, has years, even decades at the Federal Reserve, and we're thrilled that he is with Bloomberg Economics. He joins us this morning off a tour de force of history. Look for it. It is a big take this morning on the present and the past of this Fed, maybe the future as well. Dr. Wilcox, thank you so much for joining us. I want to go back to Arthur Burns, and I have trouble with the comparisons now to Burns. I think most of them are out of tune. But that paper he did in Belgrade years ago, The Anguish of Central Banking, was from the soul. That was a Burns who was crushed. He gave that speech. How crushed are we going to be in 2023, 2024 with our present Fed theory?
Burns's speech is well worth going back to read. It was from the soul. It was an anguished cry, and it's now recognized as deeply mistaken. In the audience on the day when he gave that speech was Paul Volcker, who knew differently. He understood central banks could control inflation. We're living in Volcker's legacy today. I think the Fed's task is not going to be easy going forward, but much easier than it would have been had it not been for Paul Volcker.
Let's go to the micro of David Wilcox. You just wrote for the Peterson Institute on rents in America. That's front and center. Does Jerome Powell and his team at the Eccles Building, do they understand that parts of inflation matter?
Absolutely. They're looking at the whole package. The Fed has to take responsibility for delivering overall inflation that matches their 2% objective over the medium term. They're well aware that there are going to be some stubborn components like the rent pieces that you point to, Tom.
So at what point, David, do they say, we understand that this is a little bit stickier in certain areas, so we're not going to target 2% over the next 3 years. We're going to target 3%.
I don't think they're going there. I think Powell is bound and determined to deliver 2%. He's pursuing sort of a Horton the elephant kind of policy. He means what he says what he means. 2% is their objective. That's what I expect them to deliver.
David, you've done this great piece today with Tom Orlick. The Fed's past crises hold secrets to tackling future recessions. And there's this brilliant graphic in there by Alexandria Hall. And it has frost and snow over the Federal Reserve. It has thunder and lightning. Then it has sunshine and rainbows. We certainly don't have sunshine and rainbows over it right now. David, this is a difficult moment for central banking. And I wonder, given what we've experienced in the last couple of years, whether you look around the world at the moment, the Bank of England particularly, whether their independence is going to be threatened because of their failure in some people's minds to control what has played out.
I think the longevity of their independence will depend on how they respond to this current situation. Great institutions, even great institutions, make mistakes. Really good ones make fewer mistakes, but the best among them learn from their mistakes, pivot, and adopt appropriate policies going forward. I think that's what we're in the process of witnessing with a central bank like the Fed. If they succeed, I think their independence will be secure. If they fail and don't deliver low and stable inflation over the medium term, then you could see an institutional threat.
There is a piercing debate now. You know it well, David. You've lived it over the decades. And I'm going to call it with the leadership of Olivier Blanchard pushing against Waller of St. Louis, now a Fed governor as well. Who's right?
It's like a great mystery novel. Nobody knows the answer right now. And there are two very coherent opposing camps.
David, it's just TV and radio. You know, nobody's listening. Nobody of importance is listening. Who's right in this debate?
I don't think we can say right now, Tom. Blanchard and company have history on their side. They say correctly that the kind of move that Waller and his co-author Andrew Figueira anticipate has never happened before in history. The weakness in their argument is that COVID-19 and all the economic dislocation it accompanied have never happened before. So
John,
we've not seen the last unprecedented move.
Nicely said. John, we've got to get Dr. Wilcox some media training here. I mean, David Wilcox has just got to loosen up and say, hey, Blanchard's right, or hey, Waller's right, whatever.
I don't think that works in his world, Tom.
Doesn't work in his world.
I don't think that's media training.
David Wilcox.
David, thank you.
Economics. I mean, Lisa, I think you might have a point there too.
Yeah, I mean, that's sort of the opposite.
I'm not sure that's the media training that PRs provide to people these days.
Say radical, bold things.
Just say radical things with conviction, which you don't necessarily believe.
That
Exactly.
defines 80%
Hey, Tom,
of what
look,
we're doing.
on threatening central bank independence, I think that's a very real and present threat. In the United Kingdom, I think it's a conversation that's really taken a hold over the last 12 months. And I stress that these are failures in the minds of many. I'm not suggesting they've failed. I'm just suggesting that some people think they have. Failed to contain inflation, which was their mandate.
John, these are threats in these more beleaguered economies. And you're right that Europe and the United Kingdom are way more beleaguered right now than the U.S. with its relative leadership.
Well, let's take the U.S. Chairman Powell has been accused. It has been suggested by a former Fed official that they did not make that pivot earlier because he hadn't secured a second term yet and was waiting for clarification about leadership. Lisa, that is problematic, to say the least.
Especially because if we delayed by a month, 2 months, it does make a material difference in terms of how quickly inflation could pick up speed and accommodation to help it along. On a longer term trajectory, how much does the Fed respond to the borrowing costs of a nation and the lack of fiscal stimulus by easing further? I mean, there are these other issues of independence that become very concerning heading forward, especially if there is a downturn. And there does need to be some sort of fiscal response because there is not the monetary policy ammunition to really counter it.
What happened to the Federal Reserve and the big concern about inequality? Do you remember that in 2020? What happened to that?
Well, they now have more to worry about.
They seem to shift with the mood of the country, though. And Lisa, they're meant to be independent of political pressure and the mood of the country. You're meant to make hard decisions.
Yeah, well, I think that right now the hard decision is hard. And I think that right now that's what I want to hear from Jackson Hole is, are they more worried about runaway inflation or are they more worried about torpedoing the growth? And that, I think, will be something that's really kind of evenly split in this world right now.
Looking forward to the coverage next week. But can we stop calling them brave? I mean, who are they accountable to? It's not. What's brave about hiking interest rates?
About brave?
People talk about the brave, you know, how brave they are to hike rates and let's stop that.
The Fed was perceived to do a slight pivot and show that they are willing at some point to slow the pace down.
It's likely to be shaky and shakier for GDP. Risk assets are still quite at risk for a hard landing.
The market, I think, is ignoring at least several factors that are really a problem right now.
Essentially, the market is always kind of on edge. Is China going to shut down?
I'm sure markets are listening to the Fed, but they're not really hearing the message.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thrilled you're with us on radio, on television, on Tuesday. Elections across America. We've looked at that this morning, but far more amendments to opinions by strategists. John, we're beginning to see it. We saw it with Anastasia Amoroso earlier. George Saravelos at Deutsche Bank published moments ago. Everybody tweaking their call in the tumult of an early and middle August.
Well, we're marking to market, aren't we, Tom? Isn't that what we're doing here? We've just had a 20% rally on the S&P 500, up 17%, close to, on the S&P 500 off the June lows. I think we're just marking to market. And Bank of America, with Michael Hartnett, with that fund manager survey, and I love reading that piece every single month, we're no longer apocalyptically bearish, but we're still bearish. And too bearish to expect an immediate turnaround of the bear market rally. They are patient bears, if you got all of that.
There's no question about that. Amoroso on the equity market saying maybe we won't revisit the bottom. Saravelos saying, you know, with the energy action that will need to be taken, maybe the euro won't weaken as much as to seem. But, John, this brings up the tone of the moment across equities, bonds, currencies, commodities, and that is the measurement of the apocalyptic Bramo. I mean, it's out there, and I'm sorry, the apocalyptic Bramo is really what we're talking about.
Nice. Tom, I would say the less apocalyptic Tom Keene, who's talked about the resiliency of corporate America.
They'll adjust.
You've been right, and they've adjusted. And Tom, Chris Harvey of Wells Fargo has talked about the weakness that everyone's expecting, just to wait, because it's not going to come anytime soon. He's saying the first half of 2023. And I think more and more people getting on board with that, particularly, Tom, after that blowout jobs number we had a couple of Fridays ago.
And I believe it was J.P. Morgan. My brain slips right now, but they emphasized the jobs report over the also better than good CPI report as well. And Lisa, it's in the micro data. Walmart Grimm a number of weeks ago, and they actually did better than good.
They crossed a very low bar. Let's put it that way. They have downgraded their expectations over the past few months, and so they did better than that. And they are expecting earnings per share to decline over the year, but not as much as they previously expected. Zooming out, okay, let's just be clear about something. Nobody's been calling for the apocalypse except for perhaps a couple of people on the peripheries, but I have not been calling.
Come on, you're so close to naming them then, apart from who?
No, I'm not going to go there. But I'm not saying that there's going to be an apocalypse. There is a sliver of a soft landing that people are seeing with the disinflation of commodities prices. And that, I think, has really shifted the mood away from apocalyptically bearish. I can't say it either. Tom? Really? You're just going to leave me here hanging?
It's just, what would we do without you, Lisa? I mean, we're going down in flames here this morning, folks. John, let's do a data check and save ourselves from the apocalyptic conversation.
I'll do that right now. There's nothing apocalyptic about it. We're down about a tenth.
It's good.
On the S&P. On the Nasdaq, we're down about a tenth of 1% also. Yields are a little bit higher by a couple of basis points on a 10-year to 280.77. Crude was lower yesterday. 1 point it was lower this morning. It's bounced back now to a 90 handle on WTI. $90 up 0.8 of 1%.
Right.
More weak data, more trouble out of Europe. Where do you want to look? You'll find it wherever you look. Gas prices heading in the wrong direction, higher. Investor confidence in Germany heading in the wrong direction, lower. Euro dollar negative a third of 1%. Tom, 101.29 on euro dollar.
Yeah, DXY out near 107 gets my attention. John, moments ago, the 2-10 spread was a negative 39 basis points. That's a long way from the gloom, 10 basis points.
The 50s last week,
Yeah.
Tom. I think it was Wednesday morning, just bringing up the story on the Bloomberg. Negative 58 Wednesday morning. It was the low of the session. Low of the year, I think, Tom, as well. Negative 58 basis points. You've got to go back to the early 2000s for that kind of inversion.
This is beyond well-timed. I really want everyone to lean forward and listen to Michael Bell. Mike Bell is global market strategist at J.P. Morgan Asset Management, and he is more than aware of what the Quant Combine is doing at J.P. Morgan, led by Mr. Kolvanek. Mike Bell, the J.P. Morgan call here, and I understand there can be nuances between strategists and, say, Michael Ferroli in economics, but you people have an incredibly optimistic glide path for reduced inflation. How do you do assets? How do you invest if you believe in a really nice path and rapid path of disinflation?
Yeah, look, I should lay out that I think that's the investment bank view. But if we look at the view here from asset management, our view actually is that inflation's going to struggle to come down as much as some people think. Ultimately, I think that wage growth is going to stay strong until unemployment moves higher. And that's going to keep core inflation at least significantly above target until we get a recession.
Where does that leave corporate profits? Bank of America came out with this note yesterday, Mike. Savita Subramaniam and the team said a CPI miss and an average hourly earnings beat plus weakening demand equals bad news for corporates. Those three things, Mike, do you expect that through this year? And is that bad news for corporate America?
I do think the big risk at the moment is to corporate profits, because when you look out there, yes, there are a couple of good indicators telling you that at the moment we're not in recession. You've got strong payroll growth, you've got the strong ISM services survey, and you've got the fact that it looks like we've probably seen a peak in inflation. However, if you look at most of the other indicators, they're starting to flash warning signals that actually we're kind of at the turning point that we tend to see before we head into a significant growth slowdown and the hit to earnings that you get. So I look across the board, you've got weak manufacturing data, you've got weak consumer confidence, you've got weak housing activity, you've got tightening lending standards. All of this points to a world where actually I think that it's too soon to sound the all clear and say that that recession risk has gone away.
So, Mike, are you less apocalyptically bearish or more apocalyptically bearish than you were a couple of weeks ago?
Well, I wouldn't use those words, but ultimately, I think that the market's been enjoying the sunshine over the last few weeks, and I don't think that's going to last. I think that if you look at some of the lead indicators of the labor market, look at job openings, look at the NFIB survey on hiring plans, just look at the consumer confidence difference between those who are saying that jobs are plentiful minus those who think it's hard to get. All these indicators are starting to roll over. So actually, the majority of the macro data that I look at is starting to point in the wrong direction at the same time that the market, of course, has been rallying. And so that disconnect probably won't last unless you believe that the market already knows that a recession is on the way and is looking through that. But that would be very unusual because historically, the market has never bottomed before the unemployment rate at least starts rising.
It sounds like you have quite a bit of conviction, Mike, which makes me wonder whether you're aggressively selling into this rally and holding a lot more cash ahead of the next leg, or if you're just basically viewing this with some caution and not buying in.
Yeah, I mean, my view is that it's made sense really since February of this year to be neutral on stocks. That's because of the concerns around higher energy prices, what that would do to the economy. And now we're starting to see a lot of that economic data roll over. The reason I'd be neutral rather than underweight, though, is because, as we've seen in these last few weeks, you do get these pretty strong bear market rallies, which can make it very uncomfortable if you're underweight and tempt you to kind of chase that and then get caught offside. So I think it makes sense to stick with neutral on stocks, make sure that one's not underweight duration, because I do think we're in a place where if we do head into a recession, the Fed and central banks around the world are going to cut rates more than is currently priced in. So I would look to be broadly neutral on stocks and bonds at the moment, and just looking for a point where we actually find ourselves with a significant hit to corporate profits, with growth slowing down and unemployment rising. And that's the point at which to go overweight stocks.
Mike, very, very quickly here, I want to go back to the beginning, Mike, where we really underscored how parts of a big bank can disagree with other parts of a big bank. How do you use the strategy research of Marco and others that look for a more quiescent path of disinflation?
I mean, so we take the inputs of all the different sell-side houses and we'll consider them when forming our views. And I mean, of course, where it's helpful is to bear in mind that there is disagreement, lots of different opinions out there. So one possible path is that you do see a material deceleration in inflation and that we get a soft landing, that inflation comes down, wage growth can come down to a level that's consistent with target without getting a recession. Now, it's possible. I don't think it's the base case. But again, that's one reason why I would look to be more neutral on stocks rather than taking big underweight positions. But as I said, in my mind, the most likely scenario is that to get wage growth down to a level that's consistent with at target inflation, or even anywhere near at target inflation, is going to require workers to have less bargaining power. And that tends to only happen when the unemployment rate rises.
Mike Bell, very diplomatic. Mike, thank you. Of JP Morgan Asset Management, Tom. He's in asset management, Marco's in the investment bank.
But I think a lot of listeners don't understand it. They just see it as JP Morgan. And John, that was a beautiful walkthrough of how different parts of a major bank and all the major banks can, with a nuance, disagree with each other. They agree to disagree with each other.
It's like the show, Tom.
Yeah.
Different views.
Yeah.
Walmart's CEO, Doug McMillon, is speaking right now.
He's apocalyptic.
Here's a headline for you. I think this is really interesting and maybe speaks to the economic situation we're in. Lisa, Walmart is seeing more middle and high-income shoppers, according to the CEO.
Which is a benefit for them, considering the fact that they want the higher margin items, not just the grocery items. How much are they going for this to compete with Amazon? We didn't even talk about the Paramount Plus purchase by Walmart to try to get their subscriptions up to be a real competitor to Amazon.
Come on, the Grey Poupon mustard at Walmart is $5.83.
You tune into Paramount Plus for the Italian football. That's what I've got it for. And nothing else.
Are you getting the Walmart subscription?
I don't know what that is. What is the Walmart subscription?
So they're trying to be the competitor with Amazon. Instead of Prime, they're going to have Paramount Plus.
They're going to have, and I'm going to have Walmart Prime.
Yeah.
Oh. Do I get the same one-day delivery? Is that how it works?
I don't know.
And I get free Italian football?
We got to go.
I'll try. Walmart's up in a pre-market by more than 4%.
They have great
Futures
Poupon.
are unchanged. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Union said it is studying Iran's response to a proposed blueprint for reviving the 2015 nuclear deal, and it is consulting with the US on a way ahead for the talks. Iran appears to be seeking further changes. If there is an agreement, it would free up Iran to export oil to global markets. Now, Singapore's Prime Minister is in waiting. Lawrence Wong warns that the US and China may sleepwalk into conflict over Taiwan. Wong spoke in an interview with Bloomberg editor-in-chief John Micklethwaite.
We are starting to see a series of decisions being taken by both countries that will lead us into more and more dangerous territory. And you could easily see near misses, accidents happening around Taiwan Straits, around the South China Sea. It has happened before.
Tensions between the US and China remain elevated. On Monday, Beijing announced new patrols around Taiwan following the arrival of another US congressional delegation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The thing about corrections, we've already had a sharp one this year. Corrections kind of love company. They come in pairs. They come in bunches. You can go for many years without. Then all of a sudden you get a few. I think we get one more this year. From there, I do think the S&P can rally to 4,100, 4,200 by the end of the year.
David Bianco there, the CIO for the Americas at DWS, looking for a retest of the lows of the year later this year, then ultimately a rally towards 4,100, 4,200 on the S&P. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures down not even 1/10%, just a little softer this Tuesday. On the Nasdaq, we're down 0.02%. We're going nowhere. Yields up a basis point, a little bit more than that, to 280.23. On a 10-year, Tom. Euro-dollar negative 0.25% at 101.34, and some really interesting numbers out of Walmart. Some really interesting headlines. They've cancelled billions of dollars in orders, according to the CFO. They go on to say that shoppers are buying more store brand goods.
Yes.
And the headline we brought you a little bit earlier, I'll repeat again, and just in case you missed it, they're seeing more middle and high income shoppers. Tom, they're the kind of headlines you read when things are getting a little bit more tricky in this economy.
There's no question about it, and I should say there's a huge tradition of moving to private label when things get tough. I just did a quick scan on the internet, John, and you look at Grey Puma mustard. We make a joke about it in America, but the fact is it's $2 something at Walmart, and the equivalent at Whole Foods, fancy where Lisa shops, and it's $4.79.
You're going to shift, Tom, from whole paycheck.
I mean, it's a really interesting conundrum, but it is the micro decisions, John, that are made every day in retail.
It's getting ridiculous, and you know it.
It is. A future's negative
Super
2, and the
expensive.
NASDAQ actually green on the screen. It's the same tape action that we saw at 9:30, 10 o'clock yesterday happening an hour earlier. We'll have to follow that. We are thrilled to bring you Brian Nagel out of Wharton. He's with OpCo, Oppenheimer and Company, with the optimistic John Stolfus. Mr. Nagel is forced at gunpoint to look at the glass as half full every morning. He's also expert on retail. Brian, who wins at retail in the next 18 months to 2 years? Of the different segments, which is your strong buy?
Yeah, good morning. So look, we heard, I think I'll answer that one way, but we saw, I think, a very strong report from Home Depot today. So I think the home improvement category, from a category perspective, is a winner in retail over the time frame you laid out, Tom. I also tend to think, look, I think the athleisure category, and that's why names like Nike and Lululemon, I think, are very well positioned here. Then another category that I've been recommending for a while, which I think there's a lot of underlying strength at this point, is the auto parts category, and leading operators such as AutoZone and O'Reilly. I mean, the commonality across all these is they're healthy spaces with good underlying consumer demand, and then dominated by really strong, highly functional, good operating companies.
Brian, let's stick with Home Depot for a second, because you really pinpointed on that. If you're so optimistic, if it's doing so well, why are the shares down more than 26% and lower in pre-market trading after the earnings report?
Sure. So look, I mean, it's no secret out there. There's a lot of market concerns, and I know some of your other guests were just talking about this, a lot of market concerns about a forthcoming recession in the United States. And if any of us take out our recessionary playbook, home improvement and housing would be victims. Okay, and that's what's been happening with the market here. As you look at, the conversations I have with our clients every day, is whether or not there's a recession coming, and then whether recession's coming and how severe it's going to be. And I think the market right now is very much continuing to take the view, despite a lot of signals otherwise, that recession is on the way. That's what's happening with Home Depot. What I find so fascinating right now is, as you look at it, you have that as a backdrop of the marketplace. If you look at Home Depot results today, okay, we can be nitpicky. Their traffic was weaker off of very strong results over the last couple of years. But I think the overall results are very strong and very unsuggestive of any type of economic downturn or recession. So you really have this argument going on in the marketplace.
Well, but in fairness, though, you are seeing even Walmart, even though they beat expectations that they'd already ratcheted down, they are talking about billions of dollars of canceled orders, a number of headwinds. They have downgraded their forecasts over the past few months, in addition to the likes of Target. At what point do you see more headwinds than you're making out in terms of the consumer not being able to spend as much, being more discretionary in terms of what they decide to buy, given the high price of basic staples?
Yeah, look, it's a great question. So, if you kind of compare and contrast like a Home Depot and a Walmart, two very dominant retailers, right, but positioned differently. I mean, Home Depot, given what they sell, and that's home improvement products, to largely to homeowners or professional customers, they're dealing with, generally speaking, a higher income consumer, arguably a consumer that's more insulated to economic pressures. Walmart's different. Okay, well, Walmart tends to cater to lower or middle income consumers that are more susceptible to economic pressures. Now, my colleague at Oppenheimer covers very closely Walmart, so I would leave the investment opinions to him. But I think that's one big difference between those companies. You're serving a different consumer. Now, what I would start, if I'm looking at Home Depot or other companies that are serving these generally more affluent type consumers, look, I think there you have, if to the extent we start to see real job issues, which we're not yet, that would start to concern me more from the consumer spending standpoint. But like right now, I think overall, again, there's weakness, there's some weakness out there, but overall consumer spending is holding up quite well.
Brian, can you just finish up by telling us what the correlation is between house prices and Home Depot profits? I think this is important given that we're all expecting the housing market to take a real beating. Does that name hold up in that world?
Yeah, so look, so when I think about the various macro factors that drive demand at Home Depot, home price appreciation is key. Okay, and it's home price appreciation over time. So essentially what happens is, if I'm a homeowner, okay, and my home is appreciating in value, I view that home as more investment worthy. Okay, I make investments in that home. That's either remodeling projects or in some cases just maintenance. So if I were to, if we were to know, if I were to learn that home prices across the United States would decline in some dramatic fashion, that would be a negative for Home Depot, no question. Okay, I don't think we're seeing that right now. There's always pockets, across the country of, certain areas maybe got overvalued. You're starting to see some softness in home prices. But, as of the last data, home price appreciation in the United States is very much intact. And I really think that's a key positive driver of demand for Home Depot.
I'll bring this up because we get some housing data in about 5 minutes. Mike McKee's going to break that down for us. Brian, awesome to get your thoughts. Brian Nagel there on the latest with housing and Home Depot and retail in America. And Lisa, that final point is so important. House price appreciation and whether people want to invest in their homes. And
it has been a straight trajectory upward over the past few years. We are seeing peripheral evidence that is very much changing. We saw that data yesterday. Home builder sentiment falling off a cliff. The data that we're going to get in a couple minutes, fascinating.
Housing starts and building permits just around the corner. Mike McKee ready in the studio in front of his Bloomberg terminal and his microphone to break down that data for you. We'll do that in just a moment. Futures down 0.1% on the S&P 500 with Tom Keene, Lisa Abramowicz and Jonathan Ferro. This is Bloomberg Surveillance. Heard on radio, seen on TV. This is Bloomberg. Some economic data in a minute. I've got to bring you this, and I don't mean to be the shopping channel, but I got a message on the Bloomberg, my Bloomberg subscriber. I'm surprised I haven't heard you guys mention the iOS B-Unit app on air. Total game changer. When I tell other users, they're thrilled to know about it. The B-Unit is available on iOS, Tom, in an app. So there you go, if you want your B-Unit on your iPhone. Enough of the shopping channel. Futures right now down 0.1% on the S&P, on the Nasdaq down 0.1%, and some stunning economic data. Mike McKee, housing starts. That is an ugly number.
Well, surprising but not surprising, John, given what's happened with housing overall and the decline in new home sales. We're seeing builders react to that. We saw their confidence levels fall dramatically yesterday, and today housing starts come in at 1,446,000. That's down 9.6% from June. Building permits at 1,674,000, down 1.3%. It suggests that The building industry is pulling back. Now the question becomes going forward, do we see a decline in hiring in construction, especially residential construction, that would bleed into those employment reports the Fed is watching? Housing completions are 1.1% above the June number, 3.5% better than last year. So there's still homes for sale. There's still homes being finished, but it doesn't look like they're going to be starting as many going forward, because you would expect in a good weather month like July, you would have seen a lot more holes in the ground.
No big market reaction here. Equity futures still down about 0.1%. Yield still up at the front end by 3 basis points. But TK, if there is a segment of this economy that this Fed can address, it is this one right here with interest rates.
Well, that's the point. And Mike McKee, let me go to you on this. And it's not about a Jackson Hole thing, because it's really not academic. But I noticed that the pullback in housing is sort of a normal pullback in a cyclical sequence over 20, 30, 40 years, unlike 07, which 08, 09, which was terrible. Is the thinking among economists that this is going to be terrible like 07, 08, 09? Or is it just a normal pullback that we're going to see?
Well, the Fed is hoping it's a normal pullback, and housing, like autos, are the most interest-sensitive sectors of the economy. And so you look to those first for a reaction when the Fed start raising interest rates or even cutting interest rates. And that's what's happening. We're seeing declining auto sales, and we're seeing declining housing starts and home sales. But the question of whether you go too far or not is kind of hard to say, because we don't know what the overall demand is. And as demographics play a big role into that, we have to keep an eye on where we are. The fact that we're still building houses, still completing houses, suggests that we're not going to see too much of a decline in the concomitant industries, the side industries like Home Depot and their results today. Still strong because people are still buying stuff, less traffic as the construction numbers start to fade, but there's people are still got to fill those homes that have been constructed.
Mike, this is by design, isn't it? I mean, the Fed wants to see the housing market lose some of its steam and is okay with what they're seeing, even with the plunge that we saw in home builder sentiment, even with the cancellations of sales increasing. This is all exactly what the Fed was hoping for, no?
Yeah, and this is the first thing that they expect to react to rising interest rates, and so this is what they're looking for. The question is, how far, as Tom asked, does it go? Do we see something like 2007, where not only the industry fell off a cliff, but when it restarted, they couldn't find construction workers because they went and found other jobs. And then the last couple of years, with immigration being curtailed, it was even harder to find construction workers. So now they're finally finding the workers, and the business is falling back. So we'll see what the overall impact on the economy is.
Hey, Mike, thank you. That's your housing starts data, down by 9.6%. Permits holding up, just negative 1.3% month over month. Tomorrow, we get some mortgage applications data. Then Mike McKee's going to break down retail sales for us, Tom, at 8:30 Eastern time.
We'll see it on housing. And, of course, housing, a movable feast. We'll have much more on that through the month of August. Right now, Gregory Dacko joins us, chief economist at EY Parthenon with Ernst & Young, of course, and we're thrilled he could join this morning. Greg, one of the great debates we're having here is an optimism seen out of part of J.P. Morgan this morning on inflation coming down faster. That buttresses up against your good analysis of a recession or lack thereof, because a recession needs to be persistent, profound, and pervasive. Is our inflation persistent, profound, and pervasive?
Well, I think, Tom, we're in an environment that's quite unique. I know there are a lot of desires to compare the current situation to prior instances, prior cycles. We were just talking about the housing slowdown. I don't think we're in the 07, 08 type of environment. We have household finances that are generally still healthy in terms of wealth at elevated levels, in terms of leverage at 20-year lows, and in terms of excess savings. Those are good conditions entering this type of environment where there will be a slowdown led by interest rate sensitive sectors. That is, as we were saying, what the Fed intends to do. It intends to cool demand. The housing sector alone is not enough. It wants to cool the broader set of indicators in terms of demand. and hope that inflation follows suit. So I would expect to see persistence in inflation, but I think the key theme on the inflation front is going to be that divergence between headline inflation and core inflation. Headline inflation is going to cool with accelerating momentum thanks to energy prices, but core inflation is likely to show more persistence going into next year.
Greg, you just went through the strength of household balance sheets and you brought us some aggregate numbers. When you look at low income, middle income and high income households, is the same true from one group to the other?
Well, I think we are going to come out of this COVID crisis with a K-shaped recovery. I know the K-shaped recovery was the theme of last year, but I think we have to be conscious of the fact that inflation is not affecting everyone in the same way. So lower families that spend more on gas, on rent, on food are likely to be disproportionately affected by this high inflation environment and see their ability to spend being constrained. The higher income families, less so. Inflation is still going to be a concern and a constraint on spending overall, but it's not going to affect everyone in the same way. I think when we look at the housing market and the direction of the housing market, what we are starting to see is that there is this weakening in home sales, which has already occurred over the past 6 months. That's feeding through to home builder sentiment. It will feed through to starts. I think there is further to go to the downside in terms of housing activity, but that will take place over the next few months. It's not over yet. We're likely to see some further downside on the housing front when it comes to overall home building activity.
So what are you looking for, Greg, in order to determine how deep the downturn will be? We talk about soft landing and hard landing, and it kind of conflates this idea of a slowdown that is probably expected across the board. What are you looking at?
Well, what I'm looking at is what businesses are doing. We are in this unique environment where businesses that we talk to are still talking about hiring workers at a slower pace, but they're still talking about hiring workers. We recently hosted the EY CEO Roundtable, and one of the key indicators that I paid close attention to is what I call the talent gradient, how companies are reacting to this expected slowdown in economic demand. And what we are hearing is that businesses are looking to initially slow hiring rather than proceed with massive layoffs. That's the first option, slow hiring, then strategic hiring freezes, then strategic layoffs, and then more broad-based layoffs. But the talent gradient has moved up. And what that means in terms of the potential for consumers to continue spending is that that should support household income going forward. The same is true for business investment. Businesses are still looking to build resilience. They're not retrenching. And that's another encouraging sign in terms of this potential recession being milder than the prior ones that we just lived through.
At least for the upper tiers, or the middle class and the upper middle class and the wealthy, but not necessarily the lower class, Greg, which are being hit on both sides, right? You're seeing the cutbacks happening more there because there aren't the workers and the wages are going up much more quickly. What are the longer term consequences of the K-shaped recovery that you're talking about?
Well, I think one of the key consequences of this K-shaped recovery is that we're going to see a different approach to labor going forward. We're going to see an approach in which labor is viewed as much more valuable than it was pre-COVID, an environment where there are difficulties to find the appropriate labor, to train them, to pay them, will mean that companies are more likely to retain their workers with more interest. But they are going to be strategic when it comes to which sectors they're working in. Sectors that are seeing the more severe slowdown in economic activity are likely to be the ones that transition more at a faster pace from this reduced hiring process towards more massive layoffs. So we are likely to be in an environment where both higher inflation and higher interest rates and this different talent gradient affect the response of consumers and their ability to navigate through this period of uncertainty. But really, my key focus right now is what businesses are doing. We know there's a consumer slowdown underway. We haven't seen yet a massive slowdown in terms of business investment and hiring, and that will be key in gauging whether we do end up in a recession and how severe that recession is.
Hey, Greg, awesome to get your reaction to that data. Looking ahead to retail sales, that's our next stop for this economy. Greg Dacre there of EY Parthenon. Just going through the sequencing here of hiring and firing. Tom, first of all, you adjust your hiring intentions before you get to big layoffs. Apple, the latest Mark Gurman story in the last 24 hours, laying off many of its contract-based recruiters in line with the slowdown in hiring we expected from that company. Right. And Tom, it's not just Apple. Of the big tech players, we're seeing it elsewhere too.
I'm really glad you bring this up, John. I take great issue with conflating contract-based employees with full-time employees. There's a huge distinction in the mind of most corporations. And what's so important here, given a bank or Apple, name the company, Walmart, whatever, any small business people watching, you lay off people where you're slow while you're hiring in other areas. I really question the apocalyptic.
You got it.
Bramo.
There we go. The
I'm not apocalyptic about this.
I think J.P. Morgan's going to go out and hire a jillion tech people this year.
I think, honestly, and just last point, and then, John, you can carry on. But I think that from my perspective, I don't know, something else. But I think it's really important to note that you have seen jobs be a lot stickier at the high ends. You're seeing that, the participation rate go back up. You're not seeing it on the low end. I'm struggling with that. That's all.
I'm just signing off the Bloomberg right now before I run to the other studio.
What you're carrying on with?
I am. Coming up, Joaquin Phelps
Ferro
of PIMCO.
running from the set.
Awesome conversation with him and Kate Moore of BlackRock. And Sam Linton-Brown of BNP Paribas sat down with me on the morning of June 16th and said, buy stocks. And I was the idiot saying, why would you want to do that? And we've rallied 17% since then on the S&P.
That's
so
very
we'll catch
cool.
up with him.
Very cool.
Looking forward to that at about 9:30 Eastern Time. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In Wyoming today, Republican Congresswoman Liz Cheney is in danger of losing her seat to a primary challenger backed by Donald Trump. The daughter of the former Vice President Dick Cheney is vice chair of the committee investigating the riot at the Capitol. Her anti-Trump stance has made her an outcast in her own party. Now, Bloomberg has learned that the Trump Organization's longtime CFO is in plea talks with New York state prosecutors to resolve tax fraud charges and avoid a trial. Alan Weisselberg and the company are accused of conspiring to avoid income taxes by giving some employees perks that were not reported to tax authorities. Even if Weisselberg settles, the Trump Organization will still face the fraud case. The price of zinc surged today. One of Europe's largest smelters has announced it will halt production in September for care and maintenance. The Boodle smelter in the Netherlands had been operating at a reduced rate because of soaring energy prices. Zinc has a number of industrial uses. American Airlines is gambling that a market will emerge for a new generation of aircraft that can cut transatlantic travel times by half. American has placed a firm order for 20 Overture jets from Boom Supersonic. The planes will not begin carrying passengers until the end of the decade. They sell for $200 million each. United Airlines and Japan Airlines have also committed to buying them. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
That would be a huge deal if China ended its COVID zero policy, because essentially the market is always kind of on edge. Is China going to shut down? If they do get rid of this zero COVID policy, I think that will be quite telling for the market, especially for the next year.
Ellen Wald, senior fellow, the Atlantic Council there on oil. A little bit of a lift today off the caution seen yesterday off China. West Texas Intermediate rounded up to $90 a barrel. Brent crude $5 higher, $95 a barrel. We will pause now and for our American audience confront numbers that I'm going to suggest, Lisa, are unimaginable. Netherlands gas, one of the benchmarks of continental Europe. This is natural gas, not petrol, not gasoline. Up 1,577% on a moving average study 3 weeks after the invasion, 727% annualized.
Well,
we'll go, Lisa, please.
Well, I mean, this is what John was saying, that right now in Europe, gas prices, natural gas prices are 12 times higher than where they normally are. And that gives you a sense of perspective of how much they've climbed.
And the surge, folks, makes for standard deviations being useless. Will Kennedy doesn't know the math, but he knows the social consequences. Senior executive editor for energy and commodities here at Bloomberg. Will give us one vignette of what all this numbers mumbo jumbo means to the people of the Netherlands or the people of the Czech Republic?
Well, it means, I'll give you two things that it means. Most importantly, it means that without significant help from governments, they're going to find it very hard to afford to heat their homes. As you say, gas, we all use natural gas to heat our homes in this part of the world. You can't afford that to change by a factor of 7-fold, 5-fold from one winter to the next. It's just unaffordable for most households. But what's increasingly apparent is it's going to be a threat to the wider economy. And you know, whether there are going to be enough jobs for people to pay anything towards their gas bills.
Right.
One thing we saw today is in the Netherlands, a big zinc smelter was shut down because it's just not affordable to run it at these energy prices. And that's going to be repeated in factories across Europe. If we look at the German power price, the German power price for next year cost 500 euros a megawatt hour today. That's 5 times what it was a year ago. The German industrial economy has been built on relatively cheap energy, and that model is falling apart.
Does the energy team of Will Kennedy dovetailed with the economics team of Simon Kennedy at Bloomberg? Do you believe governments will come to the rescue of retail and, quite frankly, as you mentioned, zinc, industrial?
I think they will have to. I think unless, and they have been already. I mean, there have been rebates, there have been price caps in different countries, different governments have done it in different ways, but I think we've probably only seen the beginning. Here in the UK, the opposition leader yesterday proposed that the UK simply cap prices where they are, and the balance sheet of the state bears the cost of higher prices this winter. It'll be up to the new British Prime Minister to decide what they want to do, but I think you're going to see more and more of these things, and the burden is increasingly going to be borne by the balance sheets of European states rather than consumers and companies.
In the meantime, as we head into winter, Will, we've heard more and more about natural gas companies, natural gas utilities switching to oil, to coal, to other fossil fuels to try to help produce enough electricity. So how much can we see the ongoing divergence that we have of oil prices going down really dramatically while natural gas prices spike?
Yeah, there is a real divergence there, which is a bit jarring, but I think it reflects wider worries about the economic slowdown. In some ways, that's caused by the power crunch we're seeing in Europe, but you know, you've discussed the slowdown in China as well, which I think is weighing heavily on oil markets. It's worth noting that as well as the flat price, where I've always talked a lot about the time spreads in oil market, the difference between what traders want to pay today and what they want to pay in the future. That's looked very tight for the last few months. We have seen those spreads start to come off, which does suggest there's a bit of slack coming into the oil market. You would normally expect that at the end of the summer. We'll see how long it lasts. But it does seem that the oil market is down because of economic weakness, but that's not reflected in European energy markets just because the supply side is so tight.
Sticking on crude oil, how much are we actually seeing evidence of this slowdown beyond just what's normal for seasonal types of changes versus simple speculation on the downturn that has not yet been observed in the data?
I mean, we have seen some weakness on a seasonal basis in US gasoline demand in recent weeks. It's clear that the high prices that consumers were paying earlier in the summer did have some impact on demand. We have seen some weakness in Chinese demand all summer because of COVID restrictions, and now people are worried about the direction of the economy. But we have seen a lot of strength to counterbalance that, as you allude to, Lisa. I mean, people are flying a lot, and again, you know, diesel demand will be driven by this switching in Europe away from natural gas to other relatively cheaper sources of energy, coal and diesel. So I think the picture on demand is mixed. I think traders are worried about the broader economic outlook. But as you say, there are pockets both of perhaps a little bit of weakness, but also very robust demand.
Will Kennedy, thank you for the brief. And it's something, folks, we have to follow day by day. We're removed across the Atlantic, but what I'm sorry, you know, apocalyptic. There it is, a word we made jokes about this morning, Lisa Abramowicz, and I'm sorry, it is apocalyptic when you look at those charts.
Well, it's game changing. And how much can the Euro region avoid recession, and not just avoid recession, but a deep recession at that, because of how high natural gas prices have gotten. And we've seen that out of Germany with the recent confidence data that we got this morning. It was really brutal.
Yeah, but the bottom line is, and I mean, I think this is really important. Governments are going to come to the rescue. It's unthinkable they won't. And then you essentially monetize or fiscalize the crisis.
Right. And you're hearing that more and more. You're also hearing, though, about substitutions. And now you hear about government saying you can't heat your pool fully on these days. And you have to keep things at this temperature. This is important because it limits some of the commercial activity, which is what's leading to some of the feelings about what we're expecting with growth.
We're going to continue to follow this, and of course, with the expertise of Will Kennedy and his team, the industrial impact across continental Europe as well. Futures -12, Dow futures -69, the VIX flat 20.12, I'll call it. I would note dollar strength this morning. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Welcome back to another Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Jamie Maggio. Two superstars of the men's game took center stage on day one in Cincinnati. Three-time major champion Andy Murray came through a marathon three-setter against Stan Wawrinka in their 22nd meeting on the ATP Tour. The Scot battled the heat and cramps as well as his opponent, firing 10 aces and 28 winners in the victory that took just under 3 hours on court. Up next for the 35-year-old, fellow Brit Cam Norrie.
I think he has a great attitude. He works extremely hard, and you know, he's absolutely getting everything that he can out of his game and out of the sport, and I respect that a lot.
And on the women's side, Amanda Anisimova moved on with an excellent opening day win over the in-form Daria Kasatkina. The American closing out the 9th seed 6-4 in the second set to punch her ticket into round two.